to CFRN, a community of believers who trade for a living. To learn more about who we are, what we do, and how we do it, call toll-free 1-866-928-3310, and we'll send you out a no-obligation information kit absolutely free. 866-928-3310. The CFRN Emini Futures Cast is now on Stitcher. Listen to us on your iPhone, Android phones, BlackBerry, and WebOS phones. Stitcher is smart radio for your phone. Find it in your app store or at Stitcher.com. Stitcher Smart Radio, the smarter way to listen to radio.
Are you ready, Steve? Andy? Yeah! Bert? Well, all right, fellas. Well, let's go!
You're listening to CFRN, the Christian Financial Radio Network.
Today's broadcast is brought to you by Audible. Get a free audiobook download at www.audibletrial.com/CFRN. Over 85,000 titles. Choose from mystery, romance, religion, science, technology, business, New York Times bestsellers, even children's books. You name it, Audible has it. With 85,000 titles to choose from, you're sure to find the perfect audiobook for yourself or to give as a gift, and it's absolutely free. Just point your browser to audibletrial.com/CFRN. That's audibletrial.com/CFRN. And become a part of the audiobook revolution by downloading your free audiobook today. audibletrial.com/CFRN.
Hey, trader, want to get rich quick? Well, good luck with that. If, on the other hand, you actually want to learn how to trade, the place to be is www.cfrn.net. Tune in Monday through Friday, 9 a.m. Eastern for our daily devotional, and then spend the next 3 hours learning how it's done from professional traders who actually trade for a living. That's www.cfrn.net. Every trading day from 9 a.m. to 1 p.m. Eastern. CFRN, a community of believers who trade for a living.
Good afternoon, traders, and welcome back to the CFRN Emini Futures Cast. This is the daily broadcast of Indeterminate Length, where we discuss all things Emini, along with some really big ideas on the finer points of trading gold, bonds, crude, sugar, the euro, and even T-bills. Joining us today from our studios in Boston, Mr. Michael Bork. From our trading desk in Chicago, Mr. Burton Schlichter. Now, to get things started, let's go to our host and founder in Studio A, overlooking South Mountain, America's largest city park. Here's Dwayne.
Good afternoon. Welcome back. Today is Friday, first day of April 2016. And I know you're all excited because Peter Eliades is going to be on the show with us today at 1 p.m. Eastern. April Fools. No. I couldn't resist. No, he will. He will be here at 1 o'clock Eastern, along with my co-host and sidekick, Mr. Garrett Jones. Now, I cannot even begin to tell you what a morning I have had, because one of our partners last night had the foresight to remind me to set up the new radio link. We have to reset it once a month on the first of the month. He had the foresight last night in the partners workshop to say, "Did you set the link yet?" I didn't. And so I rushed out and I did. Unfortunately, I set it at the wrong time. I had a live trading room on my mind, and so I set it for those hours. So this morning when I come to my computer, I see that my quote-unquote radio show already happened. I'm like, oh. So I go in and make the necessary corrections. Unfortunately, what you can't change is what's already happened, even if it didn't happen. And I spoke to the technical folks and I said, you know, that's a glitch you really need to fix. And they go, yeah, you're right, but right now you'll have to do the best you can. So the best I could do was to send out some emails to everybody that hangs with us on the internet and tell you, here's the registration link, and here's another way to get in. And I see that a whole bunch of people were able to make it in. So apparently something I did worked, and so for that I am forever thankful. I'll look at my inbox and see how many people have sent me hate mail so far. Hey, not so bad. Okay. That's good. All right, let's start the show out by taking a look at the numbers. Now, let me say this. If you are joining the show today for the very first time, you've got a couple of options available. You can listen to simply the audio. Nothing wrong with that. You can do that from the homepage of our website. Maybe that's where you're at right now. You just click that Listen Live button and you're hearing me. Or you may be using a third-party app such as TuneIn Radio, Stitcher. There's quite a few of them where you can listen to the broadcast. If you're on a smartphone or a tablet, you can actually download the free app GoToWebinar, and you can even see the charts on your smartphone and your tablet unless you're driving or operating heavy machinery, and then we recommend that you don't look at the charts. Okay? Now, what if you're at your desktop, you're hearing my voice, but you really do want to see the charts that we're going to display during the program today? That's a piece of cake. Go to our homepage at CFRN.net. On the right-hand side of the page, click the big microphone. Follow the instructions. That'll take you to a page. Just answer the questions real quick. Take you 30 seconds. It's what I call 30 seconds for 30 days. Because you don't have to register every day. If you register today, then every day you'll get a reminder email that says the show starts at noon. It really does. At noon Eastern each day, Monday through Friday. And you can join the show with one-click access. When you're ready to join, click here. Now, because I goofed up the times today, that might not have happened, but because I sent an email to practically everybody I know, you should be okay. Now, if you're hearing my voice and if for some reason you can't get the charts up and running, do me a favor, call this number, 866-928-3310. 866-928-3310. And that will put you in touch with Bert. And Bert, let me just make sure. Okay. I'm going to get him to admin for me, and that will sent him a message. All right, now we're going to go to those numbers that I promised you, which gives us an overall picture of what's happening in the markets around the world. Okay, hopefully you've gone through the steps. You're able to see the chart I have up now, which is the S&P 500 Emini Futures. There were some important economic reports out this morning at 8:30 a.m. Eastern. We'll take a look at those later in the show today. Now, this is primarily a show about all things Emini. So that's why we start the show out by talking about the cash markets around the world, because the cash markets do lead to the E-minis and the futures. Also, Peter, who's coming on today, is a special guest, Peter Eliades, at 1 p.m. Eastern. His work is primarily in stock market cycles. However, cycles are cycles, and I'm going to believe that carries over into the world of futures. Now, I'm as excited to hear from him as you are, even though many of you are very familiar with his work. I am familiar with him through Garrett. I've not been down the cycle road. I've been down the Fibonacci road, and I've been down a lot of different roads, but today will be my first walk down the road of cycles, other than what Garrett has taught me over the past couple of years that he's been a part of this show. So, let's do the numbers. The Dow is up 38 points on the session. The NASDAQ is up 17. S&P 500 is up a little over a point. Russell 2000 is down 3. In our commodity basket, crude oil is down $1.37. Now that's 3.5%. Gold is really taking it on the chin, down $20.80. That's over 1.5%. Going back to the indices, in Asia, the Nikkei down 594 points. Friend, that's not good. That's 3.5%. The Shanghai is up 5 points. The Hang Seng is down 277 points. Now that's 1.25%, which in and of itself is not that big a deal. However, the news we read earlier this week told us that the Chinese government was pumping $100 billion into the stock market to not just stabilize it, but to, bring back the bull. I think the bull got lost because we had one day of big green numbers, and since then in Asia, not so much. I mean, the Shanghai is up 5, but is that worth $100 billion? Time will tell. And in Europe, the color of the day, red, red, and more red. In fact, there's stuff red you've never even heard of. The MCX, the SMI, the OMX. Stuff you have heard of, the DAX, is down 170 points. That's 1.75%. The FTSE is down 28 points. That's 0.5%. And the CAC 40 is down 62 points. That's 1.5%. Okay? So those are the numbers. Europe's red. Asia's red with the exception of Shanghai, up 5. The Nikkei is real red. And then here, back home, our major indices are all green. Not by a lot, but they are green, with the exception of the Russell, which is only down 2 points. Gold taking it on the chin to the tune of $20, and oil down $1.34. Now, normally I would go to some headlines at this point, but I want to move at a brisk pace so that when it's time for Garrett and Peter to come on at 1 o'clock, we've covered as much ground as we can in regards to the Concierge Trade Alerts and taking care of any questions that you might have. And of course, we want to get a recap of everything that happened in the live trading room today. We had an open house. We had a lot of guests and visitors. And so to all of you who joined us in the live trading room today as a guest, that bell's for you. I invite you, if you haven't taken a free trial before, or if you haven't taken one in the past 6 months, we would love to have you. All you need do is go to apply.cfrn.net, and your free trial, you'll get a couple of emails today. You'll get enough information to keep you plenty busy over the weekend. And then your free trial will start Monday morning when the live trading room opens at 9:30 a.m. Eastern. And so, Michael, if you're ready, we'll go ahead and swing the camera and the boom mic over to you across the country. And you'll give us a recap of everything that happened in the live trading room.
I didn't change my name. Hold on.
Did you spot the error in the radio setup? I was so proud of Joel and myself because he thought of it and I actually did it. Yeah, we set it up last night. I just plugged in the wrong times. Yeah, true story. And
that
so,
is a problem.
yeah, I fixed it for all the days going forward for the rest of the month, so nobody has a problem. But there was no way to undo the radio show that supposedly happened but really didn't. And yeah, so I sent out emails to a few thousand of our closest friends and said, if you're having any problem getting logged in today, try this. And so hopefully that worked. We got some people here, so
That worked.
apparently
We
somebody
do have
figured,
people here.
apparently
Yeah,
somebody figured out a way to get in, huh?
Yep. Yeah, we
Okay.
got a good crowd. We had actually this morning. We had a good crowd too.
Yeah, we sure did.
The open house.
I'm going to hit mute on my end so you can get after it with the recap and do your thing.
Okay.
All right, and I'll talk to you here in a few minutes.
All right. That sounds good. Here we go. All right. Good afternoon, everyone. Today is Friday, the first day of April 2016. Today in the live trading room, let's see, we made 20 ticks on gold, 20 on the YM, and we lost 7 on the euro. Okay, that put us up. Hey, what happened to my net profit for the day? Uh-oh. Oh, hang on. Here we go. Here we go. This is the one. Let me go delete this one. Ooh, okay. You guys see where I'm going on vacation. All right. So today in the live trading room, as I said, we made 20 ticks on gold, 20 on the YM. We lost 7 on the euro. We took a total of 14 trades today. Oops, that's in the wrong column. Oops. There. We took a total of 14 trades today. So we were up 256.25 on the morning. Okay. And that is what we are up on the month now too. We've one trading day. We've now gone 61 trading days into the year. We're up $16,866 a contract. Okay, $16,866 a contract. For the 61 trading days, that's averaging $276 a day. You can see last month we were up 37.20, averaging 169 a day. The month before that, we were up 57.72, averaging 288 a day. The month before that, we were up 7,117, averaging $395 a day. The difference in here in these amounts is the volatility. You know, if we don't get any volatility, we're just not going to have a huge number of trades. I mean, look at the number of trades, total number of trades, 266 there versus 292 there versus 326 here. So right here we had about 60 trades more in that month than we did in the last month. So far this month's starting off okay. We've got 14 trades so far. That's not bad. All right, if you have not taken a free trial with us, then all you need to do, let me get up my question box. If you have not taken a free trial with us, then all you need to do is go here to our homepage at CFRN.net. And in the right-hand column over here where it says register for a free trial, put in your name, put in your email, click on register for a free trial. When you do that, you'll be sent a confirmation link. You must click the confirmation link. Okay, if you don't click that link, you do not get a free trial. Simple as that. All right, I was just reading through the questions to make sure that we got everything covered. All right, so today was our first day with no Russell. So what we did trade was the euro, gold, the YM, and crude. Okay. Let's start out with gold. We had more trades in gold than anything else, and you can see them all right here. Okay, our first trade in gold was right in here. We took 1 tick profit on that one. We missed the follow-up trade right there. Had a break even right there. Missed a trade there. On this one, we got 9 ticks profit, bringing us up to plus 10. Then we got 4 more ticks profit here, bringing us to 14. 5 here, bringing us to 19. And 1 there, bringing us to 20. We missed a trade in there, and there, and there. And there, and then it flattened out. All right, during the break, there was a bounce off the BBC right here. Right there. All right, then it needed to put in a higher swing, which it did right over here. So you could have taken a momentum long trade right in here. Okay. That was the gold today. We were plus 20 ticks on gold. Okay, plus 20 on gold. On the YM, let's scroll back here. Now the YM had some pretty good volatility. Today was our first day trade in the YM in a really long time. We lost on our first trade right here. We lost 8 ticks. Missed a trade there and there. We had a break even right there. Is that right? Yeah, break even right there. Then we got 14 ticks profit on this, bringing us up to plus 6. Okay, we missed a trade there and there and there. And right here, and there, and there, and there. And right here, we got another 14 ticks profit, bringing us up to plus 20. And right there was break even. Okay. Now, during the break, things slowed down here with the YM, it looks like. You could have taken a trade right here. I'll look at it, John. I didn't trade it at all, but I'll take a look at it. You could have taken a trade right here on the YM. And a short right in there. And that was it for the YM. We ended with plus 20 on the YM. Okay, on crude oil. Ugh. On crude, this was our only trade right here. We had some that set up that I missed in the first hour, but there was a short there, a long there, a short there, and a short there. I missed them all. I got a long trade right here. Stopped. Went to break even after we closed above the MA1. Then right over here, there was a shorting opportunity. And it got really choppy and flat. Okay. We had one break-even trade on crude today. Okay. Just looking at the NQ here, because John said it traded pretty well. We would have been looking for a lower swing in here, so we didn't get any shorting opportunities in there, or anything long right here. There was a long right here that would have stopped out. A long here and a long here that would have worked out okay. One here and one here. And then we got into the break, and during the break, it really hasn't done much at all. There was one short opportunity right here on the NQ during the break. The euro, we did trade the euro today, and look at that thing moving along there like that. Nice move up. Okay, so on the euro, our first trade was right in here. We ended up with a break even on that. Then we stopped out minus 8 ticks on this one. And it looks like I missed a couple of trades in here, one being right there, another one right there, another one right here. I took this trade right here and I got 1 tick profit, putting me at minus 7. A long trade right there that would have stopped out. And short there, short there, short there. Nope, sorry, cycle's going up too steep. Then there was some fast movement in here somewhere. I think it was, yeah, right in here at 10 o'clock when the news came out. All right, then the euro recovered all this, but the only trade setup we had was right in there. We had one right there. Okay. Then we get into the break. Right before the break, there was a long trade there, but during the break, I'm just looking at the cycle down here, and the cycle's not giving us any opportunities. So with this whole move up, using just the regular trade setups that we do in the live trading room, you wouldn't have an opportunity in there. Using the other trade setups that I teach people on Tuesday afternoons, then you would have had opportunity there. Bob, no, I heard the Russell's still, the bid and ask are still supporting liquidity over there. So that's what I've heard. Okay. All right. So as Dwayne said, we're going to move along quickly here because he wants to get through stuff before 1 o'clock comes along and the guest speakers come on. To take our free trial, just go to the homepage at CFRN. In the right-hand column where it says register for a free trial. Put in your name, put in your email, click on register for a free trial. When you do that, you'll be sent a confirmation link, an email with a confirmation link in it. You must click that, okay? If you want to skip that second email, go to apply.cfrn.net, apply.cfrn.net. Just fill out that little form, and that's all you need to do. Okay, so the recap. Today in the live trading room, we made 20 on gold, 20 on the YM, and we lost 7 on the euro. Took 14 trades. We were up $256.25. Okay, that's over one trading day. On the year, we're now up $16,866 a contract. That's trading one contract 2 hours per day. It's over 61 trading days, averaging $276 a day. Okay, that is that. Slide that over here. Stop the recording. And Phoenix, if you are available, you can head back out your way.
Why, yes, sir. We are here, present and accounted for. Recap of the recap, please.
Today, it took us 10 trades and 41 minutes to get to 154. It was 156 and a quarter. Sorry, 156 and a quarter.
156 and a quarter. Took you the full 10 today.
Mm-hmm.
We'll see, guys, that happens. Some days we get done. How about take the month of, if you could, real quick. I know I've already grabbed the screen, but everyone who listens to the show or comes to our website has access to our spreadsheet, which goes back and covers every trade we've taken every day for the last 3 years in the live trading room. And it only includes the trades taken in the live trading room. It does not include any of the concierge or any of the one trade a days. It's just the live trading room, which is done in front of a live audience. Would it be possible to just like scan down the month of April and tell us just briefly, beginning at the first, like 3 trades, 10 minutes, 5 trades, 20 minutes? Is that easy to do on the spreadsheet or not?
Not on the spreadsheet, no. And we've only traded 1 day in April.
Well, I'm sorry, I meant March.
Okay. Well,
but if it's not easy, that's okay.
What I can tell you is how long it took to get the goal for the day.
Okay. That sounds
how many minutes, how many trades.
Now, when he says the goal for the day, guys, we have a goal of $100 per contract per day. In our mentoring program, we teach you how to make $100 a day. I know that doesn't pay all your bills, but the idea is to teach you to be consistently profitable. And after a training period, then you go live, and then once you increase your account balance by $2,000, then you add your second contract, then it becomes $200 a day. Now it starts to smell more like a paycheck because it actually has a comma at the end of the week. And then on a predetermined schedule, you add additional contracts one at a time. And our 24/20 blueprint is designed to take you from that first humble contract where you make $100 per contract per day, all the way up to 20 contracts over a period of 24 months. Now in the live trading room, we're committed to trading live for the entire 2 hours, no matter what happens, because That's part of our students' training, and it's also how those of you who come in on a free trial see what we do. So with all that said, go ahead and tell us the times.
Well, I'll group them for you.
Okay.
I got the goal for the day out of, let me see, out of how many trading days? We had 22 trading days last month.
Mm-hmm.
In nine of those trading days, I got the goal for the day in the first half hour.
Okay.
1, 2, 3, 4, 5, 6, 7, 8. 9 of the days, I got it in the second half hour.
Okay. So within an hour.
Yep. And the other 4 days, one of 65 minutes, one of them was 64 minutes. One of them was a red day. I didn't get it at all.
Okay.
And
that's the truth about trading right there. Okay.
And that's it, I think.
We can miss one day, but that's okay. I got 99
it looks like I'm missing one day. I think it was a 64 minute.
I got a 65. I got a 64. Do you think we had 2 64s?
Oh no! There was 10 days in the second half hour. Sorry, I see it. It was a 51 minute that I missed. Oh no, a 71 minute. 71 minute. I got it.
71 minutes. Okay. Now,
there you go.
We keep track of that, folks, not to boast or brag about how fast we can get our goal, but simply to make it a part of the historical record that it got done. It's not important how long it takes you to get to your goal each day. What's important is that you get to your goal on a consistent basis, day after day, understanding that the truth about trading is every now and then there will be that red day. You learn to handle grace under fire. Now, when you at home are trading, once you reach your goal for the day, part of the training is to actually put the mouse away once you reach the goal. I know Michael keeps trading in the live trading room, but again, that's because we're committed to trading real money in real time in front of real people for 2 full hours. And so we record how long it takes us to get to the goal as a bit of a benchmark for those of you at home, but again, not as a race. You're not expected to keep pace with Michael, who has many years experience as a trader. It's not about that at all. If it takes you 2 hours, 3 hours, if it takes the 8-hour day, as long as you're able to make your $100 per contract per day in 10 trades or less on average, then you will progress through our mentoring program quite nicely. And anytime you hit a bump in the road, anytime there's a hitch in the giddy-up where you don't make your goal 2 days in a row in 10 trades or less, back to back, we come out of the live market, we go back into the simulator, and we do some troubleshooting. We hook you up to the scope, and we figure out what happened. Now, is it possible to just have 2, I don't even like the word luck, but 2 rough days in a row? Yeah, it's possible. But if it's 2 days back to back, there's probably an underlying factor. And usually between Michael and I, we can help you figure out what that is. And then in the safety of the simulator, you spend a couple days, you regain your confidence, you hit your stride, and then you roll back out into the live market right where you left off. So if you've already graduated one by one up to 5 contracts, and then you hit a rough patch and you have to go back and sim, well, the good news is when you go back to sim, you don't have to start at 1 again. You can go right back where you left off, as long as your confidence has been restored. That's what's really important. Okay? So, wanted to explain to you why we do that. Again, it's not to brag or boast, but to just simply show that it can be done. We've all heard about the 2 points out of the S&P every day. That would be great. Well, it's not just the S&P. but any of the futures markets, 2 points in the S&P pays you $100 per contract. So no matter where your $100 comes from, it could be the Dow, it could be the NASDAQ, crude, gold, it could be a combination of the two. I know the Russell threw us a curveball now that they're charging $100 per month for the data. But, you know, if you're a successful Russell trader, we're talking about 1 point on one contract per month. That's the cost. So in the grand scheme of things, for a profitable trader, it's just another expense, you know, a business expense if you trade for a living. If you're just learning, you're just getting started, then I, don't encourage you to spend money for data that you're not going to use, because you're going to always add it at some point down the road as you become more profitable. And also a couple weeks from now, I'll be interested to see how things have played out over at the ICE exchange. If they've rethought this, maybe they roll back the price a bit, or maybe they double it. I don't know. I mean, it's their ball, and so they get to make the rules. So we just have to deal with that. Okay. So all in all, a great day in the live trading room today. Michael, I'm going to go into our good word for the day right now.
Okay.
And I know you've got some calls that you've got to make, and I don't know if you'll be here for Peter and Garrett, but if you are, feel free to chime in at any point if you have any questions. Our good word for the day, folks, we pause for this every day because we feel that it's important. We are the Christian Financial Radio Network, not the Financial Christian Radio Network. So we do take a couple of minutes to focus on what we feel is the priority in our life. Trading for us is a means to an end, not an end unto itself. Now, we don't beat anybody over the head with religion. We're not about that. In fact, I've had many people contact me before and even take our trial, and at the end of the trial, they say, it's too bad I can't, sign up with you guys. And I'm like, well, why? Well, because I'm an atheist. And I'm like, oh, well, where does it say you can't enter our mentoring program? He goes, well, you wouldn't want a non-believer in your midst, would you? And I'm like, yeah, that's kind of what the whole thing's about. When you're a believer, you try to be a good example to those who don't believe, and then maybe they get curious and ask, why you do the things you do and believe the things you believe. And so, but again, we don't beat you over the head with it. It's just there for you if you have an interest in it. And then I always turn the question around. I say, now, can I ask you a question? And they go, sure. Of all the places on the internet, which is a big place last time I checked, there's a lot of places that you can go and get training. Good, bad, indifferent, I don't know, but there's a lot of places to get training to become a trader, or a futures trader, or an E-mini trader. Why did you choose us? The answer is always the same. As I listened to you over the course of the week, even though I don't believe the way you believe, I can tell by the sound of your voice that you believe what you believe. And based on the fact that you believe it, even though I don't, the fact that you believe it, truly believe it, I know I can trust you. And that always hangs heavy in the air for a moment. And I go, see, it's already working. And that gets a good laugh. And then they make their decision whether they want to come on to the mentoring program or not, once they know that they're welcome. So, yeah, our doors are open to all people of all color, race, you name it. Our doors are open. And we look forward to the opportunity to be able to serve you. Our mentoring program goes above and beyond what so many mentoring programs do. We offer one-on-one mentoring for those who or in the mentoring program, you get public training every day in the live trading room, but then we give you one-on-one time as needed. You just reserve time, and you go through our workshops, and there's it's a full 90 days, so keep that in mind. You're going to be very busy for 90 days, but the goal is that at the end of 90 days, you really don't need us anymore. Now, most of our partners choose to stick around after the 90 days and be an active partner because they like being able to come into the trading room, even though they already know how to get their own points now. They still like the camaraderie, hanging out, coming to the workshops, and still being able to occasionally put in that call for the one-on-one mentoring. So anyway, I said all that to say our good word for the day is try less and trust more. Last couple days I've talked about in trading that often less is more. Now sometimes less is just simply less, but often less is more, and with our methodology, we truly believe less is more. In fact, new people can scarcely believe how simple it really is. Sort of like, how come I didn't figure that out? Well, you didn't, but we did, and the good news is we'll show you, and it will shave years and years of your life and thousands of dollars off of the learning curve. So that's a good thing. Philippians 1:6 says, "He who began a good work in you will carry it on to completion." If you want God's will to be done in your life, don't rush things. Same thing with trading. If you want to learn how to trade, you have to be patient. You have to be disciplined. You can't rush things, okay? The guy that wants to get rich quick overnight will usually get broke quick overnight, practically. Patience. Sarah, Abraham's wife, did that. As a result, she rushed things, and Ishmael was born. And that brought all sorts of strife and family complications. Remember, flesh gives birth to flesh. The Spirit gives birth to spirit. That's John 3:6. So be sure your plans, whatever they are conceived by God's Spirit. Don't try to salvage anything flesh-based. God said in Genesis 17:21, "My covenant I will establish with Isaac." Isaac was born as a result of God's will, done God's way in God's time. Everything that's conceived in you comes from one of two sources, either the flesh or the spirit. So be careful. People will try to involve you in all kinds of schemes to promote yourself. God doesn't need anybody's help to bless you. He can do it all by himself. That's why whenever the enemy attacks you, you need to be able to point him to your spiritual birthplace and remind him that you didn't begin this project and you don't have to finish it. He who began a good work in you will carry it on to completion. And here's another thought. If God's dealing with you about carnality, pride, or some other obstacle in your path, don't resist, don't run, don't get in his way. Like a drowning man frantically trying to save himself, until you stop flailing around, God can't do anything for you. Peace. Be still. So the word for you today is this: try less and trust more. That is our good word for the day. All right. So now we're going to move to this chart I have up, which is the S&P 500 Emini Futures. Now, we have three different things that take place here at CFRN each and every day. we have our live trading room, which happens from 9:30 a.m. to 11:30 a.m., Monday through Friday. We also have our Concierge Trade Alerts. Now, that is a list of trades that I send out to our partners and subscribers each and every night. And here's a look at the email that went out last night and the night before, where I had to issue a correction because we rolled forward in gold, and the night before and the night before. But we'll just look at last night for now. You can go anytime to emini.cfrn.net. That's this address right here, emini.cfrn.net. That's our Google Plus page. We have the largest Emini community on the internet. Here's a picture of Mr. Eliades, who will be joining us today. You can see a bio of him here. You can also see a bio of him on his site, stockmarketcycles.com. And you can also see a bio of Garrett, my weekly co-host, once a week co-host, on this page right here, CFRN Team. You access that from our home page right up at the top where it says CFRN Team. Just click that, scroll down, and it tells you all about Garrett and all the amazing things that he's done over the course of his career. So I'm telling you, we have two heavy weights when it comes to the world of cycles and trading with us today. So we're really honored to have them both. We've worked a while to arrange our schedule with Peter's schedule, and so I want to get you through a couple of the Concierge Trade Alerts, because at the top of the hour, that's when Garrett and Peter will both be logging in. Last night on the S&P 500, we told our subscribers to sell 2045.75. And if we take a look at our chart over here, here's 2045.75, this line right here. Now, if you're new to the show, you've never heard me say this before. If you're a regular, you've heard me say this thousands of times before over the last decade. We're now in our second decade of broadcast history. Important prices and important areas are almost always tested. What does that mean? Okay, this first move down through the trigger at 45.75, the swing low is 42.25. So we're talking a 3.5 point move. Okay, that's not bad. Remember the old saying, everybody always talking about, oh, if you could just take 2 points a day out of the S&P. Now, Michael does it one way in the live trading room. We do it another way with the Concierge Trade Alerts, and even another way with the One Trade a Day Alerts. And you can learn more about any of those by just emailing us, support@cfrn.net, or calling us at 949-42-EMINI. Now, look what happens. Price gets back above the trigger. Important prices, important areas, almost always tested. And it comes down and puts in a swing low right here. Actually right here at 2040.50. 2040.50. So that's, let's see, if it was 2040.75, so that's 5.25 points. Correct my math if I do it wrong. Michael's usually my math guy, but I think he's on the phone right now. So we have a 3.5 point move and a 5.25 point move, and then important prices, important areas. We get one more test and one more drop. Now, something that you'll notice is the move that requires the smallest stop typically delivers the largest reward. And here it is playing out again, and the swing low is 20.35 1/4. So that would be 10.5 points. Okay. Now, if you're looking to take 2 points a day out of the S&P on a 5-day week, that would be, 10 points. This moves 10.5. Okay. And it almost went zone to zone. And that's a whole nother aspect of what our partners have access to, which is the weekly trading zones. And as you can see, these go out on Monday morning. This was the Sunday night Globex Open. Price number 1 will consolidate at a zone. Consolidation. The number 2 thing that will happen is it will be rejected. Consolidation, rejected, back to the zone. That's an 8-point move, zone to zone. So there's 8. Well, first there's 8, and then there's 8, then there's another 8, then there's another 8. 4 to 8's 32. Okay. Now, this is what a hot knife through butter looks like. That's the third and last most likely thing that will happen. But the good news is the hot knife through butter sets us up for this trade, because when we slice through it like it's not even there, price will almost always come back, touch that zone that it sliced through, and set us up for a beautiful zone-to-zone trade from 34 to 45. That's a 12-point move. We've been publishing the zones since December 14th of 2009, and you can go out on the internet, you can Google CFRN weekly trading zones. You'll get a page full of results, articles I've written, and at the top of the page you can click the Images tab and see charts going all the way back to 2009. Now this move went from 46 to 61, so 46 to 56 is 10, so that's a 15-point move, zone to zone, and then couldn't quite make it. Zones are an area. Sometimes buyers will come in early. Sometimes sellers will come in early. But sure enough, we hit the zone, and what do? We consolidate, and then we make a run at the zone below. We miss it by a few ticks. Zones are an area, much like Fibonacci. I know that Fibonacci plots a specific price point on the chart. So do the zones. But we have to accept the fact that they are an area. And so some of our guys have become very skilled at actually taking these zone-to-zone type trades. And even those who don't trade zone-to-zone use them as a backdrop. Now, we have done the zones for years for the S&P, the Dow, the Russell, and of late the NASDAQ. They perform equally well across the different markets. It's up in the air what we're going to do with the Russell. I've got to see how many people are going to continue to receive that data feed, and we'll take it from there. I'm hoping to see that a large number of people will, because I really enjoy. Now these are last week's zones on this chart. The S&P was this week. I haven't updated this chart as of yet. I'll do that later today, and I'll put a chart out on the Google Plus page at emini.cfrn.net. Now let me scroll down. Looking at your recent trade calls, they're all profitable, but not without money management. Yeah, Tom, that's what I teach you in the private mentoring sessions, is proper money management. The indicators will tell you when to exit the trade, and I will teach you how to read the market, because the market itself tells you where to put your stop loss. And so that's all the pieces of the pie. You got to know where to get in. You got to know where to put your stop. And you got to know when it's time to take your profits. And so, through proper training, we make sure that all of our students are equipped with that knowledge. Okay. Yes. Many trades, when you're going for a large move of 5, 10 points, you're not going to achieve that with an 8-tick stop. If you want to use an 8-tick stop, then you need to be trading in the live trading room where your goal is 2 points. Okay? So you have an equal risk-reward type ratio. If you want to trade the Concierge Trade Alerts, and if you want to trade the 1 trade a day, that's a whole different style of trading, which again, that's why we have the private mentoring sessions. Good. Okay. So now you understand. Beautiful. David Jim had some personal issues come up. As far as I know, he's okay. I've been meaning to check in with him. Oh, I talked to Dan yesterday, guys. Dan S., who created the daily performance tracker that's out in the members area of the website. I spoke to him. He is okay, but he works for Oracle. I've told you before, Silicon Valley firm, that Oracle, and he's a traveling salesman, really, and he has had his territory enlarged, and he's been on the road constantly. And he said to tell those of you who have emailed him, dan@cfrn.net, he'll do his best over the weekend to work through those emails and get answers out to those of you who have run into any kind of a hitch with the daily performance tracker. So keep an eye on your inbox. He's okay, and he'll be in touch. Garrett is here. Peter is here. So I'm going to open up their mics and say hi to them both, introduce them both. I'll put this chart for now so it's not distracting. I'll just throw it back to the S&P because we've already discussed that. When we finish our discussion today with Peter and Garrett, I will do a complete recap. I'll cover the Dow. I'll cover crude oil. I'll cover gold. I'll cover the bonds. All of the markets that we do Concierge Trade Alerts for, I will cover each and every one of those at the end of the show today. I'm going to start by opening up Peter's mic, or I'm sorry, Garrett's mic, so that I can say hi to him, and he can have the honors of introducing Peter. So stand by as I scroll up and locate him. This is the day that we've all really been looking forward to. And I know you're glad the day has come. Okay. Garrett, you have an open mic. Welcome to the show.
Thanks, Dwayne. Good to top of the morning to you. How are you?
Top of the morning from the bottom of my heart.
There you go.
Now, you and I can say that because we're West Coast guys, but the East Coast folks, they're looking at each other. What?
Yeah, actually, we're deeply into our day, too. So, anyway, well, it's a nice sunny day in California in the drought season, and I'm going to the Giants baseball game tonight with my daughter, so how does it get any better than that? I'm on the show with you and Peter, so, Man. That's got to be a good day.
You got it going on, don't you?
Yeah, this is a good day. So, anyway, I talked to Peter this morning to get him. You've already got.
I've got a copy of his website up for all you guys, stockmarketcycles.com, and just to give you an idea of what Peter looks like. And now, would you let me? Is Peter ready to go? I can open his mic.
Yeah, he should be. I talked to him earlier and got him set up so that he's looking at what I'm looking at, and then if your software is as efficient with Peter as it is with on my end here, we should be able to hear him.
Okay, Peter, I'm going to open your mic up right now. Peter, you have an open mic. Welcome to the show.
Thank you very much. Can you hear me okay?
Oh, man, I can hear you. What a great radio voice you have.
Thank you.
Well, it's
the
such a
cat is-
pleasure to have you on the show. We've talked about you many times. I don't know if your ears were burning or not, but we have a big audience who they're just fascinated with your work. They're fascinated with Garrett's work, and Garrett has shared a lot about some of the things that you've done. But I want to give Garrett the opportunity to introduce you because he really knows you. And Garrett, take it away.
Put me on the spot, huh?
Yeah.
I met Peter back in the late 70s when we were mere children, and we were on the speaking circuit back at that time. And so we met Bob Prechter back at that time, and Stan Weinstein, and a whole bunch of guys. So it was really a great era, and I had respect for Peter's work, and we built a friendship over the years, and talked about the market and exchanged information, and worked together, and had a lot of fun. So that's kind of the initial intro, and I think what might be interesting, Peter got into the business in a very interesting way, and it might be worthwhile to have him tell that story because it's fascinating. I mean, and Peter, give him a little of your prior background. I mean, this is a great story, and I can tell you this story, but it's much better. It's much better coming from Peter. He lived it, and I only I'm third party here.
All right.
So,
Peter, you got the center stage.
But a great story.
Well, again, I'll try to do it in a compressed fashion, but I don't often enjoy talking about myself. But Garrett's story that he was going to tell was about when I lived in Southern California. I visited a friend in San Clemente, and on his coffee table was a book called The Profit Magic of Stock Transaction Timing by J.M. Hurst. And at that point, I was just getting interested in the stock market. I was working as an entertainer and up very late at night, and so I didn't usually get up in the morning and follow the market. Made my first investment in December of 1968 in a fund called New Earth, which so far that year had been up over 300%. And immediately after I bought it, went down about 25% in about 3 or 4 weeks. And I said, well, wait a minute, I better learn about this business. So I was in Hollywood. I went to the Hollywood Library virtually every day for several months and got an interest in the market. Fast forward to going to my friend's house and finding on his coffee table that book. And I said, do you mind if I borrow this for a couple of weeks? And he said, no, go right ahead. So I did, and it got me fascinated with cycles in the stock market, and that's where the whole burning fire within me began in terms of both, especially cycle analysis, but obviously technical analysis also. And as they say, the rest is history. So I'm tired about talking about myself, and that's it.
So I referred to you in one of the emails I sent out to our audience to invite them to the show today. I think I referred to you as the piano man. Is it true you went from Harvard to playing in piano bars?
Yeah, actually, I graduated Harvard with a Bachelor of Arts degree, majored in physical sciences, and then went to Boston University Law School. Graduated BU Law School and took my bar exam. And then I left for New York City because music was always my first love. And I started playing and singing in clubs in Manhattan. I think I played every piano bar in Manhattan at the time.
Apparently you got that, Peter, you got that your bar thing mixed up, I guess, huh?
Yes, I think I did. Yeah, from passing of one bar to the other. Anyway, in New York City, about 2 or 3 months, my mother called, said, oh, honey, you passed your bar exam. You can come home and practice law now. And it was a fabulous opportunity because, unfortunately, my dad had just passed away, and I could have walked into his very successful practice. But at the time, I said, no, not right now, Mom. Maybe sometime later on, but I'm into my music career right now. So that's what I did for 3 or 4 years in New York City, did an off-Broadway show, worked a lot of clubs, and in fact, one club story. If a fellow walked in the club, I was working on First Avenue in Manhattan, and this gentleman walked in and he started looking at me and got closer and closer and kind of sidled up to the piano and said, did you go to law school at BU? I said, yes, I did. He said, what the hell are you doing here? So anyway, that's how my career began in music. And then the coffee table incident provoked me to start doing research on cycles in the market, and it became a burning passion from that point on. That was probably in the very late 60s, early 70s. And then I started making forecasts from the cycle work I was doing. I was calling a broker in Los Angeles. The brokerage firm was a sponsor at KWHY Television, the nation's first financial television station. And they got fascinated by some of my forecasts because they turned out to be fairly accurate. And I ended up they said, come on in, we want to talk to you. And I ended up going and being at KWHY for several years after that.
Now that was the first financial television show, correct? Or was it a show or a network?
It was the nation's first financial network. They covered the stock market all day long. That's all they did. Ultimately, it ended up to be an Hispanic station also, but they continued to do the financial broadcasting for a long, long period of time. And then finally, we had networks like Financial News Network, which was the precursor to CNBC. And I think slowly
now let me ask you, WHY compared to CNBC, in my opinion, and I don't mean to offend anyone affiliated with the station, but CNBC seems to be as much about entertainment as it is about information. And you know what? This radio show's kind of the same way. How would WHY compare back in the day? Was it more information focused, or was it a little bit of both?
KWHY was a fabulous TV station because for those of us that are involved with technical analysis, that's not all they did, but it's a big, big part of what they did. And so it was wonderful. In those days, there was a big ticker board behind you, and you could hear the prices changing with the big clicks. So when click, 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 wow. Everything was updating behind you. And it was a fascinating time. Now, I will say this, Dwayne. Those were great days for technical analysis because they had Gene Morgan, who would do a half-hour show at the close of the market, about half hour after the market closed, strictly technical analysis. He showed charts. And we're going back now to, remember, the early 70s, and we didn't have the kind of computer power and stock market graphical magic that we have today.
Right.
Mostly hand-drawn charts, but it worked out wonderfully at the time. CNBC, which followed Financial News Network, Financial News Network was good also because they had a lot of technicians on, and they allowed you to talk about the technical side of the market. What happened after that, unfortunately, with CNBC, was that they did become not only very much an entertainment network, but they became a talking heads network with people that really didn't know what they were talking about. I mean,
I'm so glad you said that because I didn't have to. Thank you.
Yeah, my friend Pete Uwald used to call them BBFs, which stands for bullishly biased fundamentalists. And, that's odd. You'd hear from them as a talk that had really nothing to do with the what was going to happen in the market. So it was unfortunate. I started making many appearances on CNBC. In fact, this was Financial News Network at the very beginning. They started doing a lot of technical work too. And for a few weeks there, they had hired me to be the daily technical analyst. And at that time, there were now a nationwide network. We went from coast to coast. So those were pretty exciting days. And it was really the beginning of technical analysis on the television nationwide.
Now, for yourself, we know that you picked up the book off a friend's coffee table. Garrett claims you never gave the book back. I don't know if that's true or not.
Unfortunately, or fortunately for me, it is true. I hate to admit it, but it is very true.
Beyond J.M. Hurst's work, where did you go to learn technical analysis? Because there wasn't a school where you could go and take a class or a course. I myself am self-taught with help from a few friends like Mike Reed of Trade Stalker and a few others. Garrett, I've learned a lot from Garrett. But how did you learn technical analysis?
It was, bit by bit and little by little, and being resourceful and saying, I want to learn all I can about it. As I mentioned earlier, I went to the Hollywood Library about the stock market, but there was so little at that time on technical analysis that the thing that really got me started with the technical side of the market was that Hurst book. And that started leading me into other directions of technical analysis. And I became, I guess, little by little, I became friendly with some of the, some of the greats in the business. Larry Williams at the time, Joe Granville, some of the people that, because of my appearances on KY, that I got to know pretty well. And they, of course, were talking about technical analysis all the time. And from recommendations that they made, I'd go in different directions, research different people. Anyone at all that had any kind of reputation that was a technical analyst is someone I'd become interested in and look into their work. So it was just by bits and pieces that I slowly put the whole thing together, Dwayne.
Now, I've heard, Garrett, and you might know the answer to this as well, there was one book I've heard that was sort of like the first, Bible of technical analysis, and I know I'm going to get the name wrong intentionally because it will jog your memory and possibly cause you to remember the name of the book. I'm going to say Fibber and McGee, but it was...
Edwards and McGee.
There we go. Okay, I did it. It worked.
I like Fibbers and McGee better.
McGee and Molly, right? Is that right?
Well, I like
McGee and Molly.
Fibonacci.
That's correct.
Yeah.
Well, you guys are showing your age, I'm afraid.
So now that book, Garrett, do you remember when that book was published?
I don't. It's been around for a long time. I can probably Google that. And
but was that like one of the first books that talked about the head and shoulders type patterns and those kinds of things? That's not something that I actually use today in my technical analysis. I respect it, and when I see it, I understand it, but it's not a cornerstone for me. But all of the old technical analysis work. And I like what Peter said a few moments ago. Back in the days of KY, technical analysis worked really well. In other words, the patterns and the things that we learn today, before all the computerized stuff came along, it really just, because every now and then I'll get into a market or I'll see a move in a market and I'll go, wow, that's like a textbook example. Is that how the markets flowed back then? Did they flow more freely than they do today because of all the computerized stuff we have and all the talking heads?
By the way, quick interjection. First edition was 1948.
Oh.
I grabbed my book here.
Before I was born. Okay.
So my copy was 1966. So these things.
1948.
In response to your question, Dwayne,
yeah.
I'm not, that's a good point that you make. And I'm sure that the computerized function in the market now, as we know by these flash crashes that we've had and silly things that go on that are really quite unfortunate. Obviously, the market and the trading places change. But one thing that never changes, as we know, is human psychology and human behavior. And that's really what the market is all about. So even though in terms of what we look at as technicians, the graphics have been greatly advanced, and we're very fortunate, I think, now to have the type of graphics and computer power that we have. But the underlying market, I believe, has always and will always remain the same because of human psychology.
Mm-hmm. Yes, I believe that very much. I know that when I'm looking at a chart, what I'm really looking at is I'm looking at all the other traders around the world who are on the other side of that chart. And when things happen like double bottoms, or we don't quite get a double bottom and buyers come in early, I'm understanding and trading the psychology, the thoughts that are going through the minds of the other traders. Okay, I know the market's going to find support here, or at least I believe it will, so let me get in early. Let me make sure I don't miss this move. And I also am a firm believer that it's much easier to predict how a group of people are going to react to a certain situation than it is to predict how a lone wolf is going to react to a certain situation.
I think that's absolutely correct. It's a good point to make, too, because we're always dealing with group or mob, if you will, psychology.
Mm-hmm.
I mean, there will always be that complete and abject fear at market bottoms and great joy and bullish feelings at market tops. I don't think that will ever change as a group. Obviously, we like to think as technicians that might be able to get a pulse for the market at tops and bottoms. It's really difficult to go against that tide, but you've got to fight yourself, and an awareness of the fact that that's how markets move will make it a lot easier to buy a bottom or to sell a top.
Well said. Well said. Now, Garrett mentioned that I believe you've got some charts that you're willing to show us today.
I do. I don't know how we're going to hook up, but you look into my computer.
It'll be a piece of cake. What I'm going to do is I am going to turn over the presenter to you. If I can get my computer to cooperate. Here we go. Make Peter the presenter. Now you should get a little pop-up on your screen that says you've been made the presenter, accept, and then if you have multiple monitors, it'll give you an opportunity to choose which monitor you want to display.
No, I see it right here. It says, you're the presenter. You've been made the presenter. Please close confidential windows. I don't have any of those, so I won't worry about it. And when ready, show my screen. So should I click that?
Yes, sir.
See what happens?
Mm-hmm.
Okay, and you let me know if you see my screen.
Houston, we have no problem. I can see your chart perfectly, and I'm going to enlarge it so the rest of the audience can see it very clearly, and it's beautiful. Tell us about it.
Fantastic. Okay, this is just our money management chart. We started a seasonality program in January of 2005 was the real-time implementation of it. I actually started it before that and researched it for several years. It very quickly, it involves end of month, beginning of month seasonality. We didn't tell people that for a long time, but they know that. And these are the real-time results through the close of February. So it's almost completely up to date. And a couple of things we're real proud of, and one of them being how we performed in the 07-09 bear market when the S&P was down about 55%. Our program was actually up about 33% over that period of time.
Really? Okay. That is very impressive.
Those series of B's that you see there are simply bottoms that show that, each important bottom in our program has been higher than the previous bottom. We're pretty proud of that also. There have been a couple of close calls, but so far each bottom has followed a previous bottom, and it's been higher.
Yeah, I could see there's a couple of nail biters in there. Okay.
Yeah, absolutely. There are some close ones. And I guess the third thing to point out that we're very proud of is that the greatest drawdown in a market which we're talking about 11 years now, going on our 12th year of real-time implementation. And we've seen a drawdown in the market of, as we said, 55 to 60% back in 07-09. The greatest drawdown, a monthly greatest drawdown on the program is about 20%, 21%. So we're very proud of that also, especially in light of the volatility we've seen in the bear market that we've seen in markets. That bear market, I'm sure you know, Dwayne, from 07 to 09 was the second largest bear market in the history of U.S. securities markets. at least going back to the 1900 time period anyway.
There's one thing we probably ought to add in there is that the vehicle that we use when we trade is the Ridex 2X S&P, which is 2-to-1 leverage S&P. That's what we use, particularly during this bear market. And what happens is that when you're using something that's a 2-to-1 leverage, when you see that red line there that tops in 07 and bottoms down there at the end of February of 2009, it's a 57.7% decline. The 2-to-1 leveraged long side Ridex fund was down about 87% during that time period. So that happened to be the vehicle that we had to utilize. In other words, we had to utilize a vehicle that was in the process of dropping 85% to get a return over 30% during that time period, which I say is kind of like running through a rainstorm and somehow not getting any drops hitting you during that.
Explain to us, Garrett, you say it's called the Ridex 2 times.
S&P 500 2 times fund, and it's just a 2-to-1 leverage. Their objective is to whatever the S&P is doing. Mm-hmm. The objective of the traders is to do 2 times that. So if if the S&P happens to be up 1% on any given day, if they're doing their job and they do their job well, they're up 2%. Mm-hmm. And if it's down 1.5%, they're down 3%.
Yeah, unfortunately, right?
That brings up one of the questions in the chat box. Do you short the market as well as go long?
No, not within this program. Well, let me change that answer. We up until last year, we had never shorted the market. Every position we took was a long position.
Interesting.
Now, if you see the big jump at the end of the chart, the blue line, it jumped up very high.
Sure.
That's the first time that I took a short position in the market with the funds. The program was not structured to do that, but it was August of last year, and I said, oh my goodness, I mean, I just couldn't withhold myself from taking advantage of what I thought was a fabulous situation to go short the market on a dual leverage basis also. So that big move up towards the end of the chart with the blue line is actually a leveraged 2x leverage short position. Let me make one other point though, because Garrett brought up a very interesting point about the 2x performance. Mm-hmm. I think it makes it all the more impressive for the program that when I told you we had our greatest drawdowns around 20% on a monthly basis, remember that occurred with 2x leverage. So on a market-based basis, our greatest drawdown basis to market was around 10%.
10%.
So I think it made it all the more remarkable, I think.
That's very
nice.
And
also the other thing is, most of the time when you see a great drawdown, you're going to see a big bear market. I mean, virtually almost every money manager who's had a big drawdown has had it in that 2007 to 2009 period. And in our case, you can see on there that was a time period where we were up sharply. Our biggest drawdown didn't occur at that time period at all. It happened, I believe, in November of 1911, right around there. Wasn't that? I think
2011.
Yeah.
Yeah.
Okay.
I mean,
Garrett's a century behind us here.
Now,
what did I say?
You said 1911.
Yeah, I must be thinking of percentage amounts, but 2011. I'm sorry.
There's a question. What is the difference between SSO and Ridex?
Not much. I think they're both attempting to do the same thing.
Okay.
So it's the expertise, I guess, would be the answer to that.
No. Wait a minute. Now, SSO is an ETF, right?
Right.
Okay. One of the huge differences is that ETF people pay commissions. We don't.
Okay. So tell me how does Ridex differ from an ETF?
Because it's a no-load mutual fund.
It's a no-load mutual fund. Okay. All right.
So it's funds. that goes on there.
John B. asks, what is the specific symbol for the RightX 2X fund?
It's RYT, RYT as in Texas, N as in Nancy, and X as in X-ray, RYTNX.
Okay. And is that something that's open to the general public? Anyone can participate in that? Okay.
Definitely is.
Now, Tom asks a question. Do you agree that all markets cycle?
Oh, absolutely. I mean, I agree that everything in life cycles. I mean, that's my theory of life. After spending so much of the past, what is it now? So we're talking 40, almost 50 years now of doing cyclic studies in the market. Mm-hmm. I see it happen. You just see it happen in life. It happens everywhere. I had a friend, a dear friend, and I won't her name, but she was the wife of one of the big celebrities in the country who's now deceased. Okay. But she suffered from manic depressive symptoms. And I explained to her the whole theory of cycles and how it relates to human behavior also. And I think, at least she told me, that helped her significantly through her manic depressive periods, because she started to recognize, these ups and downs. Uh-huh. And because I said to her, you sometimes you're so far down that you just want to die and you think there's nothing left in life. On the other hand, and that's the time to be hopeful because your cycle is probably about to turn. On the other hand, when you walk around and say, oh, do I have this market figured out or what?
Oh my goodness.
Let me tell you what I did today, Dwayne. You want to know how much money I made? When you start walking around like that, you better be careful. You better watch what's going on.
Peter, I hear myself in those words. We have roughly 700 clients, and especially with the newer clients, when I get the phone call from the guy who is, it's on speakerphone because he's doing the Fred Astaire. In other words, he's tap dancing on his desktop because of what you just said. He is on top of the world because he just nailed it, killed it, crushed it, knocked it out of the park. Anything you can think of to say about how awesome he is as a trader. A little piece of me dies because I know that guy is the same guy who in 2 days or 2 weeks is going to be calling me, not from on top of his desk, but he's going to be curled up in a fetal position under his desk, crying about how he got slaughtered, nailed, killed, smashed. And so when I get the first call, and hopefully I get the first call first where they're on top of the desk, because I try to, without raining on their parade, I try to talk them down off the desk, bring them back to earth, get them in touch with reality, and help them to understand that today's a good day and there's nothing wrong with feeling good about today and having a good day. We all enjoy that, but know that the pendulum swings both ways, and the mark of a truly great trader is one who can handle with grace and dignity whichever way the pendulum swings today.
Welcome to the world of cycles.
Oh my goodness. And the cycles, for those who are wondering, well, what are cycles? You wake up in the morning, groggy, you have coffee or however it is that you wake up. Maybe you do yoga, doggy down, I don't know. And then you go through the hair brushing and the teeth brushing, and you're off to the office and you work, and then you lunch, and then maybe you nap with your pants off like the attorney on The Good Wife, and then you come home and it's dinner with the family, and then back to bed, and then the cycle repeats, and it repeats until you get to Saturday, where you get to sleep in, and that's a larger cycle or a smaller cycle. I guess that would be the larger cycle that the weekly cycle fits inside of, because the weekends, that's a good question. Okay, we have our daily routine, And then we have our weekly routine, like things we do on a Saturday or a Sunday, which is the larger cycle.
I have no answer for that.
How about you, Garrett? You want to take a stab at that?
I always apply time to a cycle to make that determination. So,
Okay.
if somehow you can throw time into the equation, maybe you come up with an answer on that. If you can't figure out what's going on in the daily, take a look at the weekly.
You guys want to see more charts?
Yes, sir. You bet.
Okay. There, can you see that? That's daily AD line, New York Stock Exchange.
Okay.
A couple of quick stories about this. First of all, as technicians, we know or should know that if you go back historically, and I have daily AD figures back to 1926, so we now have about 90 years of them. It's a maxim, it's a technical maxim in the market that the market almost always, I would say 95% of the time, the daily AD line tops out before the overall popular market indexes. And we're getting very, very close to overtaking the top of the AD line that we saw last year. I'm kind of hoping that we won't, because I don't know if you've ever heard of him, Dwayne, but there's a gentleman by the name of Terry Laundrie and the Laundrie T theory in the market.
Yes,
Have you ever heard of him?
I absolutely have. I read a book or been to a website. I'm familiar, yeah.
Okay, he was a brilliant guy. He was an MIT graduate, became a really good friend, another one of those phone friends that I never met in person. He lived on Nantucket Island off the coast of Massachusetts. I think he very seldom left there. But he had a theory about the markets, what he called the T theory. And generally and simplistically speaking, it just said that when you find the center post of a T, the build-up period where the market rallies is the left-hand side of the T, and the right-hand side of the T shows you where that top should expire. That's a very simplistic and quick explanation. But using Laundrie's theory, I was saying for several years coming into 2015, I gave a couple of potential areas for a major top in the advanced decline line, and they didn't work out. And these were part of Laundrie's theory, my interpretation of it. But finally, come early 2015, I said, okay, this is the very latest point where Laundrie's theory allows for a major top in the AD line. And it happened that it was between, I believe, April or early April and early May of 2015. Well, as you can see, that top where that horizontal red line begins occurred on April 24th of 2015. And so I don't give credit to myself for that. I give credit to Terry Laundrie. And I would love to see that AD line not be penetrated. We came within 300 units at yesterday's close of the AD line actually penetrating that. Does either of you have the AD statistics in front of you for today?
I don't. Garrett, do you?
Yes, I do. So let me.
And if anyone in the audience has those numbers, if you want to type those into the chat box, that would be great.
The ones from TradeStation are showing 1242 advances, 1792 declines, 1245, 1797 now.
So this is interesting on a couple of bases here. I think that this is going to be a double top in the daily advanced decline line. And isn't it interesting that virtually all the numbers I see in front of me for the day, from the S&P being up over 6 points, the Dow up 61 points, the AD line is negative by 400 or 500. That's very interesting, and that's how market tops occur. So that's going to be very interesting to follow. So I wanted to show this daily AD line just to show you how very close we are to going to new all-time highs. And should we do that, a bull can make the argument that because new highs have been made, then the popular market averages should follow with new all-time highs. There are a lot of reasons why I don't think that's going to happen, and I will go into them hopefully as I show some more charts.
Okay.
But I did want to show that daily AD line. The next chart is one of the reasons, actually. This is a fascinating chart to me. This is a monthly chart of the Dow Jones Industrial Average going back to the late 1920s. You see at the very left of the chart there, you see the 1929 top, September of 1929. Now, here's one thing I want to point out, Dwayne. I discovered this several years ago. I looked at the chart and I said, my goodness, look at all these periods of 150 months, most of them on the button, but some of them plus or minus 2. I think there's an extreme where one of them was 147 and one was as long as 152. But all of these periods of 150 months plus or minus 2 months, 3 in an extreme, to very important market turning points. I don't know how clearly you can see that chart, but I have the dates down below where I show all these turning points and how, some of them were tops to bottoms, others were tops to tops, but they're all important market turns. And look how many times there was approximately 150 months between them, which of course is 12 and a half years. So what I told people, again, coming into 2015, I wanted to write a book last year and say it's about time. And of course, you can take that a couple of ways to say it's about time. But really, for me, in cycles, market timing is obviously all about time. But 2015 was the year that I think brought everything together to say it's about time. And one of the reasons was this pattern of 150 months. Mm-hmm. If we go back 150 months from May of 2015, it actually takes us to the October of 02 bottom. Obviously, a very important bottom in the market, right? Which led to the 2007 high, and there was almost a double bottom in March of 03. But those were the last important market turns in the market until 2007. So if we were going to have another important 150-month segment taking us to an important top, it either had to occur from October of 02 or from March of 03. So the May high was 151 months from the October of 02 bottom, fit perfectly in the pattern. Mm-hmm. Now, so you could say, well, wait a minute, what about the March of 03 high? Well, if that were to have occurred, then you could add a few months on, take you into October, November of 2015. But after that, there was no period that would show you a 150-month important turn to important turn until the year 2020 again. So if we start going to new highs and we top in the next year or two, let's say sometime, then this is going to throw out it'll throw out of the water this claim that we're going to see 150 months in between some important market turns. That's one of the reasons why I say that I think strongly that May of 2015 was set up to be an important market top based on this 150-month cycle.
Something that you said about we almost had a double bottom.
Right.
Now, that's something that I teach my students to watch for as we're approaching a double bottom in any time frame. Doesn't matter if it's a smaller time frame for intraday trading or a larger time frame for swing trading, is that buyers have a tendency to come in early, and the reverse is true of sellers, for fear of missing out. Yeah, and so that's why we'll quite often, especially in the smaller time frames, you're waiting for that double bottom to fall into place so you can put in your buy order or your double top to put in your sell order, and it doesn't quite get there. And people are mystified. Well, gosh, why didn't it get there? Because people don't want to get left out. So.
That's right. They were jumping the gun. Mm-hmm. Well, and listen, the best show of what you just said, Dwayne. Well, we had kind of double bottoms last year in August 24th low and the September 29th low were almost double bottoms. And again, this year, the January and February lows were almost double bottoms. So that's a perfect example of what you just talked about.
Very good. Thank you.
Okay, so let's do this. let's look at, I've got a whole bunch. By the way, these charts that I'm going to show now are in my most recent report that I wrote a couple of days ago.
Also, before you leave today, I want to make sure you let the folks know how they can subscribe to you have a monthly newsletter, is that correct?
Used to be a newsletter. I'm out of the newsletter business. What I do now is I do an online report every 4 to 6 weeks, and sometimes more often if market situation demands it. And people can get online on my website and get access to the report we charge $19.95 for those reports. And
wow,
if they
you can't beat that price. Now, your website is stockmarketcycles.com, correct?
That's correct.
Okay.
That's correct.
Just want to make sure people know how they can get a hold of you after the show today. Okay, go ahead.
Thank you. I appreciate that. Okay, so now this is an up-to-date chart, actually. This is an intraday S&P futures continuation chart, and it includes Globex. So look how interesting this chart is, though, and how interesting it became over the last few days. Let's go over. Can you see? Can everyone see the numbers there that are delineated on the chart?
I can't. They're a little small. I don't know. Do you have any way of blowing them up just a tad?
Yeah, let me see if I can blow them up a little.
Now, I love the fact that you include Globex, because I'm a huge Globex fan. I believe that Globex is becoming less and less of a shadow market and is, in fact, almost becoming the engine that drives Wall Street versus the other way around. Now, for a moment there, it was blown up real big, and we could see it.
Yeah, hold on a sec. I'm trying to get to, I think.
How about your little plush thing down in the lower right there? There you go.
Oh, perfect.
Okay.
Yeah, beautiful. Beautiful.
Can we see the numbers now?
Yes, we can see the numbers.
Okay. So this goes back to around July, August of last year. And again, it's a continuation chart, E-mini contract, S&P futures. Let's look at this because it's really a fascinating chart. Point one is, it's not the low on August 24th of last year, because that was really, if you recall, on a particular day, we had this huge move down and then a huge move back up. Mm-hmm. There was really no stability in terms of that low. The more stable low came, I believe, the next day. When
was that some sort of a flash crash that we had on that day?
You could make that argument. I'm not sure if it was or not.
I can't remember what happened on that day. I don't know if it was at a Fed day, perhaps. But anyway, go ahead.
Anyway, the more stable low was at 0.1, which I believe was the very next day, because we came down and we did some work around that level. So that was an important low. And now that we've come into this time period, what I joined the low on that August, I believe it was August 25th, to the February low of this year. That's 0.6. And as it turns out, 0.4, which was the January low of this year, falls almost exactly on the line. The number 4 went slightly beneath it. But as you can see visually there, it went almost exactly on the line. So now what I love to do, and I've become more and more enamored in the last year or two with parallel channels. I always liked them, but now I've fallen in love with them because they seem to work so incredibly well.
Now, for those who don't understand a parallel channel, you've connected 2 and 3, and then you've created an identical line, and the angle is the exact same. It's not where you've drawn 2 separate lines, but you've got an exact copy of the upper line, and you've laid that on the bottom and attached it to 1.
But no, in reverse order, however.
Reverse order, okay.
I did the 1.6 first. That's the bottom line. And then I said, okay, let's move that up to the November 3rd high, which is 0.2. Now, look at what happens here. This is amazing. And I want technicians in your audience to do this with their own charts if they can, because these are things that amaze you. If you take that parallel to lines 1.6 and put it exactly to the penny on that November 3rd high, which is 0.2, you will find out that the December 2nd high, which is 0.3, falls virtually exactly on that line. So in other words, if you had drawn a trend line, forget about line 1.6, if you had drawn that trend line, 0.2 to 0.3, the exact high on November 2nd to the exact high on December 3rd, that would follow that line that's a parallel of 1-6 virtually perfectly all the way to the end of the chart.
Mm.
That's the magic that's involved with technical patterns in the market.
Yeah,
I mean,
and this is the stuff that just fascinates me, this geometry that's built into the market. Every morning I wake up, I look at the chart, and it's like a lotus flower opening every day, and I'm seeing how it's going to unfold today. And some people think it's just weird, but man, I find it absolutely fascinating.
So I guess you're not what they call a random walker, Dwayne.
Yeah, no, I'm as sick as the rest of you guys. Yeah. You know, the guy who wrote the book, Random Walk Down Wall Street, Burton McKeel, he has been a guest on this radio program.
Okay.
He's a nice gentleman. We didn't fist fight. He seems to have softened in his later years. He's not as convinced, I don't think, of his original theory, but he hasn't given up.
Let me ask Mr. Malkiel how he can look at a chart like this with a 1 and 6 and 2 and 3 and call it a random walk.
Yeah.
Okay, he can say, well, all right, that was a coincidence that one time. Well, all right, should I show you a few thousand more coincidences, Mr. Malkiel? Okay, let's follow up on this chart, though.
Right.
So we have excuse me one moment, I had to cough.
Sure.
We have lines 2 and 3. Now, there's another technical line I'd like to draw, and that's from the high in between the January-February low of this year. That's represented by 0.5 on the chart.
Okay.
And that goes through the 0.8, which is the high that occurred just before this little rising wedge was broken. So that 5.8 follows up to 0.9. Now, when I put 0.9 on, that was actually a day or two ago when I put my report out. I think today, earlier, I updated this chart, although you can't distinctly see the bars towards the end of the chart. But what is a few things have happened here. But let me point out the third line before I say what's happened. Look at line 6 and 7. Line 6 begins at the February low, and line 7, 0.7, is the bottom in mid-March. So lines 5 and 9 and 6 and 9 form a rising wedge. And as you can see, that rising wedge pattern was broken right after 0.8 on the chart. Okay, so now let's look at these lines. There are 3 lines. Lines 2, 3, the join 2 and 3, lines 1 to 6, which are the parallel. We're not concerned with that one now. Lines 5 to 9 and lines 6 to 9. There are 3 lines that came together virtually perfectly, coincided about a day or two ago as the market was hitting that high. So to me, that's a point to be looking for a potentially very important top to be made. Now, what happens if we go above the line? Well, there's a couple of things that can happen. First of all, you see that the 5-9 line allows you to go higher and break perhaps the line that's coming down from 2 and 3. But that should still perhaps rule market movement if that's going to happen. For the time being, however, I'm going to say there's room for one more little move up here, and it looks like what the market's doing right now with the S&P futures around 2060. I think today those lines, the conjunction of those lines is right around the 2066, 2067 level. If we happen to get up there today, it will be an almost perfect conjunction of price with those 3 lines, and a very strong argument that there's a market top.
A question from the audience. Because the parallel lines are tilted down, and downward angle, does that speak to the fact that you believe, or that we would take from this, that the markets are heading lower? I mean, is that kind of what you're saying here?
As long as we retain within the parallel line, as long as we stay below that 2.9, line, and that, yes, that's exactly what it would imply, that we've come up to a very high risk level, at which point the market is now set to go down towards at least the bottom line, the bottom parallel line.
And I know that many traders from my camp would look at this, and again, whether it's on a large time frame such as this or a smaller intraday chart, we would see this as a low risk trade on the short side, in that we don't have to risk an awful lot to find out whether or not we're on the proper side of the trade.
That's correct. You know where you're wrong with a chart like this. You know, if it's not a question of being wrong, you know where the market has not followed along the pattern that you've shown. So, in fact, if that 2-3 line is convincingly broken, if I was short, I would not want to be short anymore. Okay, let's go to the next chart. I don't know what it is. I'll surprise myself. Let me see.
Okay.
Oh boy, what's going on here? Let's see. Stick with me. I'll find it.
Okay.
I think my blowing up of the chart is perhaps.
Yeah, you might have to shrink it back down to roll it down.
Yeah. No, you know what it is. When I see that little circular thing there, that is word is misbehaving on me, so it doesn't like. Oh, come on.
How about that little thing down there on the right? The
No, I know how to do it, Garrett. It's that when you see this circle right here, that means that it's hung out. See at the top left here, it says word not responding.
Yeah, it's thinking. So you might just have to give it a minute to kind of catch up to itself.
Yeah, I think you're right. Either that or it's going to crash on me.
Now, let me ask while it's thinking, let me ask you a question that you could answer without a chart. This is from Richard, who is a big fan of yours and a longtime member of our community. If I'm not mistaken, don't you trace the market with tracing paper and then move it forward in time to find cycles or something like that, even turning your traced market upside down?
The upside down thing, I don't know what he's talking about, but he's absolutely right. That's exactly what I do. And in fact, I will show you one of the last charts that we plan to look at today. I will show exactly how that offset thing works. We'll take a look at that and see what it's saying currently about the market. That's assuming that that word ever responds again. If you're still on my screen, that's fine. What I'm going to do is a Control-Alt-Delete.
Yeah, that's probably a great idea.
And I'm going to close the program and then reopen it again. Okay. So bear with me here, because
if anything, in the meantime, Peter, we're patient.
Peter, what you might do is pull up the newsletter. I mean the letter itself.
Yeah, but that's in the Word program also.
So yeah,
he'll have to. My Word has done that a little bit lately too. I think it's must be an evil plot.
Are you guys running Windows 10?
No, I'm not. Windows.
I'm always reluctant to go to new operating systems.
I am too. I've got my computer set up. It wants to update every day, and I've got it set to no, do not. My wife, one of her computers, we didn't have it protected properly, and it auto updated to Windows 10, and she's not real happy with it. Although I've had members of our audience say that they're running 10 and their charts are working fine, and they think it's the most stable operating system since XP. So,
Dwayne, one thing about that you might want to Google, and I forget the gal's name, but she's a Harvard grad and a security specialist, and she says she warns against definitely not using Windows 10 because it is so invasive that it will pick up not only will it pick up what you're doing and where you are and what all that stuff is, but it will pick up every keystroke you make. So if you go in and I mean, I'll try to find the link to that. But if you Google, I don't know, whatever, dangers with the
dangers with
Windows 10,
Yeah.
you should let your people know, because this woman is very well known. She's she's very good at what she does. And it picks up, in other words, the problem with picking up keystrokes, other than it's not anybody's business.
Well, I mean, that's keylogging. That's a malicious program that you put on somebody's computer.
And you can determine where that might be coming from. But the point is, when it picks up a keystroke, when you're typing in your password, which people wouldn't know otherwise, now they've got your password. So if you're for your bank or whatever it is, I mean, this is not it's something to be aware of. People have to make up their own minds on things.
Okay, guys, I'm back in operation here. Can you see my screen now?
I can see it. I can see the numbers.
Okay,
Peter, I'm going to have to run. I have a prior engagement at 11, so all
right, Garrett.
I apologize.
No, that's okay.
But you're in very good hands.
And I'm in good company. So thank you so much for bringing Peter to the show, and thank you for introducing us. And you have a wonderful weekend. And I'll tell you next week how it went. And in fact, when I upload the show later today, you'll be able to see the rest of the show.
I'll watch it later today when that happens. Yeah, I'm sorry, I didn't realize it would run over, but I'm glad it is.
Oh yeah, no, we're having a great time.
Okay, thanks.
So long, Garrett. Talk to you later.
Bye, Peter.
Okay, Dwayne, this chart that I'm showing now is the same as the previous chart, but it's a close-up. Okay. So fortunately, and it's also not only a close-up, but I updated it about an hour ago.
All right.
So hold on a sec. I've got to take a drink of water here, though, please.
Sure, go ahead.
Okay, I think we've got it now. So as you can see, we can go up. I would say of all those lines, well, I don't want to say one's more important than the other. The longest one is the one that's coming down from top left into the current pattern. That's the 1-3 line, which is not only a trend line between the November-December highs, but also a parallel channel to the lower one that we showed on the previous chart. So this is important territory right up in here. And we start going up above that, then I won't know what's going on, I don't think. I'll have to go back to the drawing board. Okay, let's see the next one here. This is the McClellan oscillator with the Dow Jones Industrial Average. Can you see that one clearly?
I can, yes.
Okay, there are two rectangles here. Mm-hmm. This is between around October, November of last year, and this is the current situation right here. What I wanted to point out was the similarity in patterns. Notice the high in the McClellan oscillator here, which is almost the same as this one here. We have 1, 2, 3 waves down to below the zero line on the McClellan, as there were here. 1, 2, 3 general waves down to below zero. A rally back slightly above as the market above it is going to higher highs. So now we have this divergence, same thing here, 3 waves down below zero, a rally a little bit above zero, a new high in the market, new high in the market. If this acts the same as this one did, then again, we should be forming some kind of top here. It's just a similarity in patterns that I found interesting. You can get into trouble with these similarities in patterns, so don't ever assume that they're going to act the same way, but oftentimes they do, and it's nice to see them. Next chart.
Does any of your work, Peter, embrace any kind of planetary activity?
Not specifically, because I don't do astronomical or astronomical configurations that I'm acquainted with. But I will tell you this. Mm-hmm. I don't know if you remember the old show Wall Street Week with Louis Rukeyser.
I do.
Well, I appeared on that show way back when, and Rukeyser asked me about cycles. And he said, Peter, what causes these cycles? And my answer to him was, Lou, I don't really know, but if you were to back me into a corner, I'd be reluctant to say it, but if you were to back me into a corner, I would think that there was somehow related to astronomical. I was careful not to say astrological.
Right,
but
and there's a big difference, yeah.
Yeah, the astronomical configurations. I said those are things that happen with great regularity, all different kinds of suns and moons and patterns and planets and whatever. But whatever they do is done with regularity, and the theory is they could affect human behavior.
Well, I mean, we know for a fact that the moon controls the tides of our oceans, correct?
Absolutely, absolutely.
And now that, if we believe in divine architecture, that a divine hand put that moon in place to tell the tides how far to come in and how far to go out, I mean, then if the moon can affect as huge a body of water as the ocean, our bodies are, I don't know, what is it, 80% water? Something along those lines?
I think it may be even more than that, yeah, absolutely.
Yeah. So, I mean, it's not too much of a stretch of the imagination without getting into anything, crystal balls and whatnot. I mean, we're not going there. We're just talking about science here. So, yeah, please go on.
I agree 100%. Okay, next chart. This is an interesting chart, too. These are just little technical indicators and things that I look at from time to time. I don't spend too much time on them. But this is a chart with the Dow Jones Industrial Average on the top, and beneath it, in kind of a rust color, is a 10-day moving average of new highs minus new 52-week lows on the New York Stock Exchange. Mm-hmm. This is updated through yesterday's close, and look what's happened. After having that huge spike down when we had a huge number of new lows, going into the lows at the beginning of the year, we now have had a nice recovery in the market where you can no longer say it's oversold. In fact, we're getting more new highs than we are lows, but it's also come up to a 1, 2, 3 pointed trend line, now becoming a 4-pointed trend line. Another reason why there should be resistance, in this case, resistance to making new highs. Isn't it interesting that the takeaway numbers for the next couple of days are pretty high in favor of new highs? So it'll be very difficult to move that line up any higher over the next couple of days unless we have a greatly increasing number of 52-week highs. So that's something to be watching too. These are all these charts were done, as I said, a couple of days ago, Dwayne, in anticipation of going out and telling people that I think for all these reasons that there is an excellent chance that we're at an important market top again. Okay, now here's what Richard, I believe that was his name, was asking about. Mm-hmm. You can see that the blue lines simply represent highs and lows for the market. In this case, that's a daily chart of the S&P composite index, and the high and low for the day. It's simply a bar chart, a daily bar chart of the S&P. What the red line represents is a tracing of the S&P day-to-day movement from the median of the day, not the high or low or close, but the median. This is an idea that was put forward by J.M. Hurst in his original cycle work in terms of doing cycle projections.
Right.
So that red line.
Now, how do you know where to start? That's a big question, I think people
Okay,
have.
well, the important thing, it's not so much where you start, it's how far you offset it to the right. Okay. You can see, let's look at the bottom right of the chart. See where that red line hits a low?
Yes.
At the bottom right of the chart? Mm-hmm. Well, that is simply the low that comes at 0.4 on the chart. But it's moved forward in time 48 days. Why 48 days? Because if you take market holidays into consideration, there are 48.4 trade days in a 10-week period. Okay, this is approximately 4.84 days in a market week, trading days, taking holidays into consideration. If we look throughout the year, how many days there were, it's 48.4. So this is a 10-week offset. You move it to the right 10 weeks.
Mm-hmm.
And what happens if it's working correctly is you get projections. When the blue crosses above the red, that should be the halfway mark of a move. When it crosses below the red, that should be the halfway mark to a move to the downside. Well, as you can see, the move between 1 and 2, this did not work.
Mm-hmm.
The market should have gone significantly higher if where the blue crossed above the red was the halfway mark. When that happens, I look back and I say, well, all right, let me see what kind of offset of this red line, if I start moving it back this way, whereabouts would it have been to have given a correct projection for point 2? You see my point?
Mm-hmm.
In other words, how far back to the left do I have to move this red line so that it would line up exactly at the halfway mark between 1 and 2?
Okay.
And the next chart shows that. There's point 1, here's point 2, here's the exact halfway mark. As it turns out, in this case, it was a 32-day offset. That gives you the halfway mark and would have given a correct projection for point 2 once you broke above the red line between 1 and 2. And what gives it a little more significance in terms of its correctness is you'll notice that I don't have the numbers in here, but this move from 2 down to 3 seems to have been charted correctly by the red line again. You can see this is a move down about 1 and a little more than 1 square before it crosses below.
Mm-hmm.
You go another 1 and a little more square, that takes you to point 3. That would have been a good projection. So the reason I show that now is if it's going to work this time,
Mm-hmm.
and there's no guarantee, and I want to emphasize that I don't do this too often. Usually the typical offsets of 5 weeks, 10 weeks, 20 weeks work very well. When they don't, I go back to the last couple of crosses and say, okay, what did work and how would that predict the future right here?
Mm-hmm.
As you can see right now, if you take the halfway mark from 4, where it crossed above the red line here, that takes us almost exactly to the high that we hit over the past couple of days. Now, we always allow for a 10% margin of error. So let's say this is around the 2060 level. This started around 1810. 1810 to 2060 is what, about 250 points. So this projection would be given maybe about 20, 50, or 60 plus or minus 10% of the complete move, which would be about 25 points. So the projection would probably end up being 2060 plus or minus 20 points on the S&P. And that's what that is all about. I don't know how much time we have left.
Well,
but,
we've still got some time. So if you've got some more charts, I scheduled for us to be able to run over today. If you had material, we absolutely want to see it.
Great, then let's do it, because this next chart is a very important one. There are 2 or 3 charts to show in conjunction with it. I wish I remember the name of the gentleman, because I hate showing charts without giving attribution.
Mm-hmm.
But I don't remember his name offhand. A subscriber sent me something in early 2008, and he said, Peter, he said, if you go back in history, you'll find that from important market bottoms, several of the important market bottoms in history, into subsequent important market tops, took an average of 33 years, plus or minus a few months.
Mm-hmm.
And he sent me the chart. The one that he sent me went back to, I believe, the 1896 low. And that would have called the top in September of 29, because from the August of 1896 low to the high in September of 1929 was 33 years and 1 month. So what I did, I fortunately had data from the Foundation for the Study of Cycles, and I had data all the way back to the late 1700s, the very late 1700s. And I said, well, let me see if that's proven to be true in the 2 prior iterations. So I went back to a bottom in February of 2002. Sure enough, went forward 33 years and 3 months. And I worked it with some of these other ones too, so I don't want to make it sound like it's foolproof, and no matter which bottom you choose, it's always going to work.
Mm-hmm.
But there was a very important low in February of 2002, and 33 years and 3 months later, we hit a high in May of 1835. This high in 1835, Dwayne, was even more important than the 29 high in the Dow because it was not surpassed convincingly until about 30 years later. So that's one iteration of that particular low to top cycle, 33 years and 3 months. Let's start going forward and looking at them, and I think you'll be fascinated by them. This is a low. I believe it's October of 1857, but I'm not sure. I think this low here there was a little crash low right down in here in October of 1857. And if you go forward 32 years and 7 months, mind you, it's the way I ended up with a cycle was 33 years plus or minus 6 or 7 months at the most. So this one is 32 years and 7 months, which is 5 months short of 33 years. And that top that we saw in May of 1890, as you can see going across here, we came up to it a couple of times a few years later, but we didn't really significantly surpass it until well into the 1900s, right in here. And finally, from that low of 1896, you had this blow-off high into September of 29. So I'm through with that chart now, but I'm going to show you some more of these 33-year iterations of the cycle on more updated charts that have a little more clarity.
Now, the gentleman that originally shared with you this 33-year cycle,
right,
did he have any sort of, is it something he just noticed, or was it the result of some other study, so there's some perhaps reason behind it?
I think from what he told me that it was simply an empirical look back and say, there's a high.
A lot of my work comes from historical observance. I notice that a lot of things happen, and I'll scratch my head, drag them out in the light of day, and I'll try to figure out why. And if I can't figure out why, I say, okay, I'll just accept that it's happened so many times that I'm going to continue to watch it. And if it stops happening, if it doesn't happen the next time around, I'll be the first to know, and I'll let my followers know. Just like with our weekly trading zones, historically, price closes below the highest zone and above the lowest zone every week, week after week, going all the way back till the first day I published them on December 14th of 2009. I didn't set out to create an animal that did that. It's just that after a few years of looking back, I was like, whoa, well, that's interesting. And it continues to play out to this day, week after week after week. So I'm with you on that in how he discovered that by just looking at the historical data. So please continue.
Yeah. Okay, this one is obviously after 29 came the 32 low, a very, very major low in the stock market down here, July of 1932. If you go forward 33 years, that would have taken you to July of 1965. This one actually was the longest of all the 33 plus or minus cycles, and it lasted 33 years and 7 months to the February of 1966 high in the Dow. One thing I want to note is how very, very important these highs ended up being. This 66 high, for example, was not significantly surpassed. This is a monthly chart, mind you, was not significantly surpassed until 1982-83 when we broke out of this very long-term pattern. So here's another 33 years, 7 months, February of 66, and there we go with a very important market top that lasted for about 16 years. Let's look at the final chart, and this one is fascinating. Look at this. This is color-coded. Look down on the bottom left here now. There's October of 66.
Gotcha.
December of 74 and August of 82. All around the same general level in the Dow, around the 600, 700, 800 level in the Dow.
Okay.
Right here in there. So now we've got 3 very important market lows within a long-term trading period. Let's look forward 33 years from each one of those lows to see what happened. This one is color-coded. It's in green. And so we've got The October of 66 going forward 33 years and 2 months. Go up here. There you go. That it would have taken you 33 years and exactly would of course have been October of 1999. You go forward and another couple of months into the top, which occurred on the Dow in January of 2000, on the S&P in March of 2000. There's another one of those 33-year periods. 33 years. I call it 2 months here. It's actually 3 to 5 months because the Dow and the S&P topped at different times. But there's another 33-year period. Let's go back to one of the most important market bottoms of the last 50 years, the October-December lows in the Dow Jones Industrial Average and the S&P. Let's go forward 33 years from there. That's in pink. We go up to here and go 33 years forward. October of 74 plus 33 years is October of 07. If you start at December, which was the bottom in the Dow, it would be 32 years and 10 months. The low in the S&P was actually October of 74. So it would have been exactly 33 years to October of 07. So you can see how these incredible patterns are coming together. Yes. Here's the 66 low. Here's the 2000 high. Here's the 74 low. Here's the 07 high. Now, the last low in the sequence had the opportunity to provide what I think will be or will have been the last high in the sequence. Because one thing that happened with these highs in 2000 and 2007 is they did not last as long as the previous highs. The previous highs, the ones that happened individually, not like a threesome of these lows here, but the lows to highs that happened individually lasted an average of about 15 years. This one only lasted, the 2000 high only lasted about 7 years, and the 07 high only lasted 5 or 6 years when it was broken here. My reason for that, and it may be right and it may be wrong, is that we have a threesome of lows that are leading to this amazing threesome of highs that will end up being the very, very important top that was registered in May 29th of 2015. And isn't it interesting, Dwayne, that from August of 82 to May of 2015, look down below here, 32 years and 7 months, which is the quick, that's 33 years minus 6 or 7 months. That would be March of 2015. 33 years plus 7 months, which was the longest previous span, would be March of 2016. So through the end of last month was the last time within this time sequence that would have been lined up for a potential top. Because it happened in May, which was well within the time window of 33 years plus or minus 7 months. Right. In fact, notice that I said 33 years, 7 months is March of, 32 years, 7 months was March of 2015. So May of 2015 was 32 years and 9 months, just 3 months short of that 33-year period. So we've got this sequence of highs that has now occurred after this sequence of lows. And of course, the August of 82 was the very latest low. And look what happened. Exactly 33 years plus or minus 6 months after that line. That's why I think this high in May of 15 will not be surpassed. If it is, then there's something else going on. And again, I have to go back to the drawing board. Okay, there's just 2 more quick things I want to show here.
Okay.
I'm sure most of your listeners are acquainted with Fibonacci relationships.
I've taught them as best I can.
Okay, so here's one that you may or may not have taught them, but look at it because to me, it's the most amazing Fibonacci sequence of the last 80 to 100 years in the markets. From September of 1929 to June of 1962, 2 very important market turning points, one of them a high, September of 29 to June of 62, an important low, was 393 months.
Okay.
Let's start expanding that 393 months by Fibonacci ratios. If we expand it by 0.382, that gives us 150 months, 393 times 0.382, 150. 150 months, all of these are going to be added, by the way, to the September of 29 high. If you add 150 months to the very important high in September of 29, that takes you to December 1974. For now, I'm just going to give you the dates. The next slide is going to show you the dates.
All right.
393 times 0.618 is 242.9 months. Actually, I misspoke. We're not going to add these two. We're going to add them to June of 62, not September of 29.
Okay.
So June of 62 plus 150 months takes you to December of 74.
Right.
June of 62 plus 242 months takes you to August of 82. June of 62 plus the next Fibonacci sequence, which is Unity 393. It's not really a Fibonacci sequence. In fact, it didn't work like the other ones did, but I just threw it in there. The next one is 1.382, and that leads you to October of 07. And the next one in sequence, 1.618, which is phi itself, probably the most important of the Fibonacci numbers,
right,
is takes us to 635 months, takes us to May 2015, because it's fractional 635.87. So I did this, mind you, I did this at the beginning of last year.
Mm-hmm.
So I said, here we go. This is May of 2015 to June of 2015. Now let's look at the chart. And I think this is a mind-blowing chart. This is the 29 high. This is the 62 low.
Okay.
And remember, we started adding the Fibonacci sequences. 0.382 took you here. This is the 74 low, from which we never went lower again,
right,
in our history. This is the 82 low. Never went lower again, a very major market bottom. And I would also add that these two lows, Dwayne, were the last time that the market was truly undervalued. I mean, truly undervalued, to the point where you'd see maybe a PE ratio of 6, 7, 8 on the Dow, and more importantly for me than the PE ratio, a dividend yield on the popular market averages of 6% or higher. This is the last time that happened. So now we look forward to what happens. This is the Unity one. And again, it wasn't any important market turn, but notice what happened right after it. That's when the acceleration of the 90s took place. The next Fibonacci number, I call it September of 07, but it was actually October. That was the 1.382 expansion, and the 1.618 expansion, again, was May of 2015. So remember that May of 2015 for so many reasons. That was the 33-year plus or minus top. It was the top of this Fibonacci sequence. And so many things came together at that time that I don't want to see that top broken, because it would break some beautiful patterns that have taken place in the market.
Okay, so
that's about the end of my slideshow. I'm certainly willing to answer any questions if you have anyone doing.
there was a question earlier. Now this goes back a few screens. So, what was the correlation percentage 90 to 50? That was asked by Gerald, and he asked that question probably 20 minutes ago, and I missed it, so I didn't.
I don't remember what we were looking at when that was asked, because I don't.
Gerald, if you'll refresh our memory on what screen we were looking at when you asked that question, and now Joel asked a question: why do you use the 1962 low?
Because it works.
Okay, well, that's an honest answer.
I mean, there's no argument that this is a very important low. I mean, the market never went lower than that low for the last 50 or 60 years.
Right.
Now, you could say that there were more important lows because you came down into them after a long period of time.
Joel said that's a good answer.
Yeah, I mean, that is the answer. It works. What you want to do
Gerald
is
says
find.
that on his projection, that on his question about the percent 90-50, he was referring to the projection forward. I guess that's when you were when you were talking about tracing it forward in regards to how often was it correct. So I don't know if.
Okay, well, let's go back to that chart. I'm not sure exactly what he's asking, but let's quickly go back to that chart and see those two charts. Here's the first chart. This is the basis of my projection work. I almost always use a 48-day offset as a basis of my projection work.
Okay.
So I do this, and
now, is that 48 calendar days or 48 market days?
And I'll tell you why it is 48 market days or trading days.
Okay.
The original Hearst work what it used to do was leave spaces for Saturdays, Sundays, and market holidays. And this 48-day offset, a 10-week offset, would have been 70 days if your chart allowed for Saturdays, Sundays, and holidays. Okay. Because 10 weeks is obviously 70 calendar days. So this would have been.
I think CQG is one of the trading platforms I've heard. I don't use CQG, but they somehow compensate for holidays in some of the functions of that platform. I don't know if you're familiar with CQG. I'm not.
I am familiar with it, but I've never used it. Okay. There is a way, I believe, in TradeStation that you can do calendar day charts. I had a guy walk me through it once. My computer crashed. My computer crashed 10 minutes after I did that. And I said, all right, I don't know if I'm going to try and do that again. But it's important that we talk about a second or so about these offsets. I don't often change the offsets. These offsets remain standard in time. The only time I will think about changing them in real time is when I see something like this that obviously didn't work at all. I mean, this called for a projection way up above the top of the chart here, and that didn't happen. I told people at the time I didn't think it was going to happen, not because I'm so bright, but because of how May of 2015 fit in with so many things that we talked about cyclically. And if we had gone to this projection up here, well above 2200, then it would have blown out of the water the 2015 high. I didn't think that was going to happen. So when it didn't happen, I looked and I said, okay, what for the interest of what's happening here? By the way, if this projection is right on the 48-day offset currently, that calls for a projection all the way up to the 2200 level in the S&P. Again, I don't think that's going to happen because of the importance of May of 2015 and so many of these cycle things. But if we start to break through that particular level of the 2015 high, which is right around here, 2100 and change, then we have to think that perhaps this projection turns out to be right. There's another point I want to make about projection work, Dwayne, and that is projections remain in effect until they are invalidated. Whether you say, how are they invalidated? That's very easy. They're invalidated by going below the projected line that gave them. So let me give you an example. Here's a projection from 1 to 2 that called for a move way up here. Well, that projection was in effect all this time after 2 until here. See where it broke below the red line? That is an invalidation of the projection. That's what we call an invalidation. So projections remain in effect until they are either met or invalidated.
Well, you know, I teach a lot about support and resistance, and people ask me, well, now how long is that going to hold as support? And my answer is identical until it doesn't.
Yeah, exactly. And when it doesn't, it's an important lesson.
That's right.
It tells us something.
Yeah, and it gives you an opportunity to potentially trade in the opposite direction because often support will become resistance and vice versa. Okay. Now, a question. This is done on a 48-day offset. All right? For a guy that fancies himself a day trader, and we have an awful lot of those in our audience, could something like this, could someone do some work and try to put together something like this for the day trader? And if so, as opposed to using a 48-day offset, what sort of an offset would they use, say on an hourly or 15-minute basis? Is that possible?
Because you're hooked into my computer, I'm going to give away some of my secrets of the universe, Dwayne.
Oh, okay.
I've never done this before, but because you're in real live time on my computer, watch what happens.
Okay.
I'm going to go to my trade station.
All right.
And within trade station, by the way, this is that same chart. Look how close we're coming to this line now.
Yes.
This is real time, by the way.
Okay.
Okay. In trade station, I have what I call 27-minute offsets for the S&P. Why do I do a 27-minute chart?
Now, is that S&P cash or mini?
No, it's the futures. It's the futures.
The futures, okay.
And the reason I do it, because in daytime trading hours, which are from 6:15 Pacific time to 1:15 Pacific time, it breaks up the trading day into 15 exact bars of 27 minutes. So let's click on that chart and let's show you what I do during the day.
Okay.
These are 7 or 8 charts with offsets on them, intraday offsets that I have figured out empirically.
And these are day session charts, not Globex.
That's correct. These are daytime only.
Okay.
Daytime. I have charts for Globex, but these are daytime only.
Okay.
Let me show you what I do here. Usually there's a span between offsets. So in other words, this red line is the offset, and it goes between here and here. So anytime you break above the line, you get a projection. What is that projection? Well, I'll show you how I get it. I go to, first of all, I want to make sure that my computer is snapping to lows. Yes, it's in the snap mode. I go to this little tool that usually shows Fibonacci relationships. I stick it on this low, and then I undo my stick snap mode, and I want to move this line to see the red and the black where the prices, the bars go above the red and black line right here. Okay, where it crosses each of those lines gives you a projection. So from here is the lower part of the projection. Down here, see the box there? I don't know if you can read it, but it says 2065.51. So that's the lower side of the projection. The upper side of the projection is giving me about 2069.75. So all I'm doing is taking from this low to the halfway mark here and saying how much further do we have to go to the upside once they're broken. So the answer to your question is yes, I do it on an intraday basis. It's software that I've been dying to get someone to implement. And if you or any one of the hundreds of people that pay attention to your show know someone that they think can write this kind of software, I would be eternally grateful.
I've got a guy in Israel that we can have a conference call with, and we can see he's really, really good, and he's like Mossad in that you can trust him. Your secrets are safe with him, kind of a guy. We've had him do work for us on our proprietary indicators, and
that would be great.
Yeah.
I'll follow up just a little bit more here.
Okay.
So when and if that projection is met, you go down to this bottom left chart here. That's the next longer offset. And you'll notice that that's giving. It's interesting now. See these boxes that I have, these rectangular check box here, they were previous projections. Note that this previous projection was met right over here on the left. It was met up there. And now we're getting a further upside projection that from this low breaking through these offsets here that would give a projection up into this territory. Let me just very quickly, without going through these specifically, take a look at further ones and I'll show you. Okay, here's another one. Let's do this one here. Let's do this projection. Here's the low. Here's the crossover right here.
Okay.
And it's going to give us a projection up there. So we go to this low. We move this up to where it crosses over. That's telling us we have a projection of 2072 to 2076.50. Now that projection will remain in effect until it's either met up here somewhere, or price goes back below these lines. It'll be invalidated and you can forget about it.
Now tell me again the lines. How are the lines created?
These are offset lines that are determined from all the research I did over the years as to what they're derivatives of the Hearst original lines, 5-week, 10-week, 20-week offsets, or 5-day, 10-day, 20-day offsets. So they're derivatives of that I brought down into a microcosm world of intraday trading.
Now, is that something that you had to create yourself for TradeStation?
No, these lines for TradeStation anyone can do if they know what they're doing.
The offset lines, is there?
The offset, let me show you how that's done in TradeStation. If I right click on the red line and go format moving average, what I want is the length to be 1, because I want it to mimic. I want the price to be not the close, but the median price. TradeStation has a function that most people don't know about, but you can use the median price of a bar.
All right.
And what all that does is it averages the high and low of the bar, regardless of where it opens or closes, and then take a 1-period moving average, which would mean in effect that you're simply doing a tracing of the median price for each bar, and you displace it. Unfortunately, I wish it were the other way. When TradeStation displaces, it calls it a minus displacement. I would call it a plus displacement because you're moving it forward in time. But if you want to do that displacement, you write minus 13. And what it now does is, let's go over here where it's clearer. See this black line that is taking place in between? Okay, that's the 1-day median.
Okay.
And all the red line is a moving forward of this closing line or median line without the bars. The bars would only aggravate the picture and make it more complicated. So these bars, this red and blue bar, are simply these median lines moved forward in time to give projections. And those are all of the mystical, magical secrets I want to give away for the day.
You've given away a lot, and I can't tell you how much we appreciate it. This has been a real treat to have you with us. Garrett has been talking about it for a long time, and we finally got you here today. And so I've had so many positive comments from the audience, and they just want to thank you very much. And are you finished with charts for now?
Yes, I am. This is just
okay. I'm going to grab the screen back here for a moment because I want to put up on my screen your website. And here we go. All right, guys, here we are at Peter Eliades Stock Market Cycles. You get there by going to stockmarketcycles.com. As you can see on my screen, here's what the home page looks like. Right there. And
right there on the home page, that's where they can get the reports.
Publishes a monthly report to give subscribers the latest market projections. The report for March 29th is available for only $19.95. That's a great price. You'll be charged $19.95 on your credit card after you enter your billing information. After payment, be sure to click the link, Return to Stock Market Cycles. The report page will display, and then if not, there's an email that you can contact for assistance. So that, and then there's a lot of other information available on Peter's site. Everything from technical information to his market philosophy to the Timer Digest award that you won.
About 100 years ago.
Yeah, that's a long time ago, but that's okay. It's an award. You won it. You deserve it. Different awards, the Charles Dow Award. That's no small thing. So a lot of information on the site. So be sure and pay him a visit. StockMarketCycles.com. Check out this newsletter. It's right available there on the home page. Just click it and go. When you click it, it's going to take you to a page like this. Just click Add to Cart. Before you know it, you'll be looking at the report. Peter, I thank you so much for taking time out of your day to come and be with us. We've really enjoyed it, and I hope you will consider coming back and paying us a visit in the future.
Absolutely. I've enjoyed it immensely, and it was nice to talk to you, Dwayne.
Thank you so much. Have a great weekend.
Thank you.
All right, guys. All right, so we're going to shrink it down, and I'm going to go here and mute all the guest mics so nobody has to worry about leaking sensitive information. Okay. And we'll go back to where we left off with the S&P 500 E-mini futures. We had already looked at the short side of the market. Okay. We had said to sell 20.45.75. We had a 3.5 point move, 5.25 point move, a 10.5 point move. Now there was another side to that coin. Now, for those of you that are new, let me explain to you why there are two sides to our coin. It's not because I can't make up my mind or I don't have an opinion. All traders have a bias. All traders have an opinion. That's if you've been a trader for any length of time, you develop a bias, you develop an opinion, you can't help it. It's human nature. Here's where the challenge comes in. Taking that bias, taking that opinion, folding it up, putting it in your back pocket, better yet, leaving it at home, coming into the office, sitting down in front of your platform with a clear mind. Because no matter what the talking head said on the way into work as you were listening to the radio, no matter what the headline on the Wall Street Journal said, no matter what your own technical analysis has told you should probably happen today, the truth of the matter is anything can happen. You have to embrace all of the possibilities. Now, look how long price consolidated at this zone, and after important prices, important areas were tested, it made a real attempt to get to the zone below. The zone's at 34. We got down to a swing low of 35.25. So we actually missed it by 5 ticks, but we still covered some pretty good ground. Then we got the old hot knife through butter. Now, look what happened on the very next candle. It came back to touch the zone. It blew through. That's just earlier in the show. I explained to you that's what we expect. Now, on the long side for the ES, we had said to consider being long above 20.62.25. Okay, we are at 20.62.75. Now, this puts an interesting situation on the table. One, we've got a Concierge Trade Alert telling us we might want to be long here. Now, last night, because I was juggling the trading room, or the workshop, and the Concierge Trade Alerts at the same time, and I'm not making any excuses, I stand behind 100% everything I publish, even when I'm a tad off, okay? And by a tad off, this 45.75 should have been a little bit below this week's weekly zone, but I stand behind it. And this 62.25, in a normal situation, those of you who followed my work know I would have probably gone out at least a point, maybe 2 points before I put the trade alert. But I put it, and I stand by it. Now, I said all that to say this. 61.62 is our highest weekly trading zone for the week. You just heard me say that historically, over the years, going all the way back to December 14th of 2009, since we first publicly published the zones, Michael and I traded them ourselves for some time to make sure the validity of what we discovered was there before we began to publish it. But since then, I can count the number of times that price has closed either above a weekly zone or below a weekly zone, the lowest weekly zone, on a Friday at the close of business. I can count the number of times without taking my shoes off. Okay? So that gives you an idea how many times. All right? Now, could today be one of those days where it actually closes above? It's possible. Now, I'll be honest, I have sat on Friday afternoon years ago. I don't do it anymore, but I have seen price get like so far above a weekly zone, it's like, well, you missed it this week. And I was resigned to the fact that, hey, this is the truth about trading. You're not going to be correct in every analysis. And no sooner did I resign myself and accept that, and that doggone thing would turn around and it would break and run like something I can't explain, and it would get right to the number or right below it. Now, I can count the number of times that's happened, but I would have to take my shoes off to count those. And I'm being serious. So, where will it end up for the day? I'm not a prophet. I won't know until the end of the day. But the Concierge Trade Alert, be it right, be it wrong, said to consider being long 62 1/4. All right, we were just going to the Dow, the YM, when Peter and Garrett came on. And again, ignore these zones because I haven't had a chance to update this chart to this week's weekly trading zones as of yet. I meant to do it last night, and I'll be honest, I got tired. Michael asked a question. Let me take a moment. Thank you, Joel, for the kind words. I appreciate it. Dwayne, can you explain how you determine when you actually enter the trade as 3 times prices dropped below 20.45.75 and you don't show the stop outs if you entered, then you show the 3.5 points, and after that the price is crossed over and below before it goes to 5 1/4 points. How do you deal with these crossovers on when you do or do not enter? Well, that's something that I teach you when I take you into a personal mentoring session. Remember, we were selling 20.45.75, okay? Now, based upon what the market is telling us, any of these little iterations here are not going to get us stopped out, okay? And then price drops 3.5, okay? Then price runs back up, gets above the trigger, resets the trade. I didn't even put this one in, and it closes or puts in a swing low at 42.5. So that would be, I guess, 2.5 points. That's what the market made available. Now, depending upon how you manage your risk, and you and I in a private mentoring session will determine what your risk profile is. If you're a brand new trader starting out with a small account, your risk profile is going to be extremely small. Now, as price rallies up, okay, and gets above the trigger, ready to come down again, the market tells us exactly where to put our stop loss. I will help you learn to see that in a personal mentoring session. Price then drops 5 1/4 points. Price then gets back above the trigger and drops 10.5. And again, the market tells you on this move exactly where to put your stop. And do you get stopped out? The answer is no. So that's the short answer to your question, but it's the answer to your question, okay? If I had more time, there's not much more I could add to that. People don't always like what I tell them, but man, I'm just always going to tell you the truth. You know why? Because I'm getting older. Now, that's not the only reason, but we don't always remember things as clearly as we get older. I mean, I'm not ancient, but it's just easier to stick with the truth because you can almost always remember the truth. Why? Well, because it's the truth. It's what actually happened. And so, with that said, it's not only the biblical way to go, it's the right way to go. All right, so on the Dow, we were looking to buy 17,635. So let's get this in position. 17,635. Right there. Okay. So let me write it down. Now again, these are the Concierge Trade Alerts, not the one traded days. By 17,635. Now, one of the things that I teach you is there are times when the market will tell you where to put your stop, and that amount of risk for what you potentially think will be your reward, potential reward on this trade, it's just not worth it, and you actually walk away. You don't take that trade. Now, the whole risk reward thing, it's kind of a fantasy, because a lot of books, and my dear friend Mark Douglas, who passed away last year, he talks in his book Trading in the Zone about risk reward and how he liked to have 2 to 1, at least 3 to 1 if he could get it. That's 3 on the reward side, 1 on the risk side. Intraday trading, it's often very difficult to get 3 to 1, even 2 to 1. Okay? So what you don't want to do is you don't want to risk more than you think is a reasonable amount of gain on the other side of the trade. Now, why I say it's a little bit of a fantasy, when somebody tells you before a trade, this has a this to this risk-reward ratio, well, the risk part is true because you know how much you're willing to risk. But the reward part, see, that's an unknown factor. That's a big question hanging out there. Maybe it is, maybe it isn't. But the risk side is fixed. You know how much you're willing to risk, but you only know how much you hope to gain, because there's no way of guaranteeing that price is going to rally up to any specific point. We have different things like Fibonacci that we can use to project points on the chart where price may rally to. And just as Fibonacci retracements are an effective tool, Fibonacci extensions can be an effective tool. Okay, are they a fail-proof standalone trading methodology? By no stretch of the imagination. They simply are one of the tools that we have in our toolbox. And so I'll just, without giving too much away, I'll just tell you on this first approach here, the risk is far too great. Okay? Now, as we move to the right, the amount of risk required to put on a trade does in fact become a little more reasonable. There is a possibility that your first try could have led to a stop out. Remember, in the Dow, you need 20 points to quote unquote be done for the day. If you're trading the 2420 blueprint, you need 20 points at $5 a point to give you your $100 per contract per day. Okay? Now, this swing high here took us up to 49. So from 35 to 49, that would be 14 ticks. And we never get out at the exact swing high. The only time you'll get out an exact swing high would be perhaps if you are new and you're still in the stage where I teach you to use a hard target and you're not trailing your stop yet. You're just trying to hit that hard target so you can get your points for the day. And especially on the Dow, I will teach you to trail your stop up to the hard target, because with the Dow, you're risking 8 ticks to make, or points. The Dow doesn't do ticks. You're risking 8 points to make 20 points, all right? And so if there's, 10, 12, 13, 14, 15 points on the table, we need 20, but we don't want to see that thing come all the way back to zero and stop us out at break even. So we're going to be aggressive even though we have a hard target at 20. So out of this 14 move, people who I train would at least get stopped out with, 7, 8, 9, 10 ticks, somewhere in there. We'll call it half, 7. But you're not going to get stomped out at break even, not if you follow the way I teach. Okay, now, price once again gets back below the trigger and fires. Now this time we've put in a swing high all the way up at 92. So from 35 to 92, it's been a long day. I'm going to give my brain a rest. 92 minus 35, 57. So there's 57 points. Now, again, the goal, if you're trading the blueprint, is 20, and this move, if you somehow knew how to get out at the exact swing high, would be 57. But you either hit your hard target of 20 and you are done, or if you've advanced beyond the hard target and you simply trail all your trades, then let me just show you a little something here. Because when you enter the mentoring program, you also own the indicator set. And just as the market will tell you when to get in, our indicator set will tell you when to get out. And I can tell you right now that when we get a candle that closes below the step line, this thing is bullish. We've got, I'm going to venture more to go on the upside, okay? But when we get a close below the MA1 and then a close below the step line, we got to be out of that trade. That's the market telling us to get out and go home. This trade's done for the day. And worst case scenario is you're going to end up with your 20 points for the day, and you'll have a little wee bit of a smile on your face, and that's good. Okay, now I gave out some Russell numbers last night because I got Russell running on my Ninja chart. I paid some money to the good folks at Bar Chart to pay for the data. But then today when I fired it up, the data wasn't running. So I put out these numbers last night based on bar chart data. I said to buy 1112 or sell 1108. If somebody wants to let me know how that went, that'd be great. Right now, I can't tell you. I got to call the folks at bar chart and say, hey, you billed me for the data. Where is it? So it started out as a free trial. And then I got a sneaking suspicion about halfway through signing all these documents that somehow my free trial, my Russell data wasn't included in the free trial. And then by the time they banged my card, I was pretty much convinced that my free trial evaporated. So I got to call them today and ask them, did you bill me or not? Did you promise me a free trial or not? And where do we stand? Do I have to just suck it up and pay and then cancel in a month? If so, then I want you to make sure my data is working properly if I've got to pay for it. And if you're actually giving me the free trial, because what they never told me was, okay, your free trial ends on this date, cancel by then or you're going to really be billed. The fact that they never told me that, that's what makes me think I made a mistake. I'll take the blame. I made a mistake. How about that? Michael says after a 4-tick move, he moves to break even. So that is, that's in the live trading room. Okay, that's what I explained earlier, Michael G, in the beginning of the show. There's 3 major things going on at CFRN. There's the live trading room every day where we're teaching new traders and traders who simply want to learn to be consistently profitable. we're teaching them how to trade with a 4-tick range chart. That's where every candle is 4 ticks tall. It's not a 4-tick chart. It's a chart where every candle is 4 ticks tall. There we use extremely aggressive risk management. We risk 8 ticks on every trade, and as soon as we have 4 ticks profit in the trade, we move our stop to break even, and then we continue to trail our stop on up until we either hit our target or the market comes back and stops us out with whatever profit we have at the time. Now, that is the backbone of CFRN, okay? Teaching traders how to become consistently profitable in the market. We do that through our proprietary indicators, our proprietary strategy, our aggressive risk management, and our definable edge. Outside of that, we also have the Concierge Trade Alerts, which I'm going through now. This is for those who are looking to take a bigger slice out of the market, and to take a bigger slice, you know, the larger the risk, potentially the greater the reward. It would be wonderful if we could take a large reward and only risk 8 ticks, and sometimes you can. You know, sometimes you get in at just the right moment and the trade it never draws down even a tick. It just takes off like a rocket. But we all know that more often than not, that doesn't happen. And then there is the 1 trade a days, and those are traded the same way you trade the Concierge Trade Alerts, okay? So anyone who subscribes to the Concierge or who subscribes to the 1 trade a day, those are separate products from the mentoring program. I spend time with you and help you understand how to better put those to use. Thank you very much for the question. So that probably cleared it up for you and a lot of folks. So that's good. Thank you. Now we'll move on to crude oil, GCLK, which will be right here. All right. Now last night the alerts got out at 9:45, a little bit later than I like to send them out, but it's because we were in the midst of first I was trying to get the Russell data through the bar chart free trial, and so I was wrestling with that, and so it was actually 9:45 when I finally got them out. And so I'm going to set the dividing line at 21:30. That's 15 minutes before the alerts actually I should put it 15 minutes after. Yeah, if I send it at 9:45, then I should put the dividing line at 10. There we go. That makes all things even. Okay. So on crude oil, we were looking to buy 38.60, which did not happen, which tells me that our sell side, which was 38, probably did happen, and it happened in a big way. So let's draw our line at 38, keeping in mind that important prices and important areas are almost always tested. So sell 38. Okay. Now, on this first drop, we get down to a swing low of 37.71. So that would be 29 ticks. That's $290 per contract. 29 ticks at $10 per tick available. That's what the market made available. Now, again, where you're going to get out is based upon if you had a hard target because you just wanted your 10 ticks for the day and be done. Okay, you could have had that. If you were trailing your stop then as price began to pull back, then you got taken out with less than 29 ticks profit. Okay. The big drop came here and took us down all the way to, well, I guess if we really want to measure the low, but, you know, when this starts, I'm thinking most people are going to head for the hills, so why don't I just measure the low here? 36.72. All right. Let me show you this first. From 38 to 37. That is exactly $1,000 per contract. One contract, if you sold it at 38, when it hit 37, a $1 move in crude is worth $1,000. A $1 move in gold is worth $100. The margins to trade them are about the same. So, guess where my heart is? I like the crude, but nothing wrong with the gold. It provides plenty of profit every day. And so there's $1,000 per contract, but we actually go below that, and we actually get down to 36.72. And so 72, so that'd be 28, so that would be 128 ticks. If somebody does the math and comes up with a different figure, 128 ticks at $10 per tick. If you come up with something different, don't hesitate to clear me up on it, okay? Because I did it in my head and not with the calculator. Okie doke. Next we have the NQ. All right. The NASDAQ. Now I normally have a 30-minute NQ chart. Apparently for some reason I changed my NQ last night. I was showing somebody something and I bumped it up. So let me bump it down. Okay. All right. Oh, I know because, yeah, I put a chart out last night. Last night, during the partners meeting, when I set it out, I said on the NASDAQ, sell 44.68. Okay? If you sold 44.68, then this swing low right here, 44.68, took you down to 44.48. That's 20 points. The NASDAQ pays $20 per point. And so, 20 points times $20 per point available. When this began to draw back, that's when you would have gotten stopped out if you were trailing your stop. And you would have been sitting there with that grin on your face. You know, the grin. Now, important prices, important areas are almost always tested. Sometimes they try and they don't quite make it. Just a couple more ticks and this would have signaled another trade, but it didn't. Okay. Now, on the NQ, we also said to buy 44.87. Okay. 44.87 is right here. Kinda. 44.87. Buy 44.87. This is going to be nice. Buy 44.87. All right. Now the first swing high before you have a big pullback is 45.0675. So let's just go 87. That's going to be 13 and 6. We're going to call that 19 points. Okay. 19 points. Available at $20 per point. On the drawback, you probably got stopped out. And again, it didn't quite pull back far enough to signal a second trade. Now, if you're one of those brave, bold individuals who does not immediately move their stop above the entry and get to break even the way we teach you, I'll teach you both ways. But you have to understand the risk that's involved when you don't take. Now here, you could have taken your stop to break even plus a tick, covered your commissions, had no risk on the trade, the market's paying for your trade if you get stopped out. If you played it that way, if you traded it that way, then the swing high up here was actually 45.17. So 87, that would be 13 and 17. I guess that would be 13 and 17. I guess that would be 30 points. Okay. At $20 a point, and it may not be done climbing. Next, on gold, let's take a look. Now we've rolled forward in gold to June. Whoa, look at that drop. Okay. So we're going to drop our line at 2200 because I sent out the alert at 2145. So we'll mark it 15 minutes after the drop. Okay? All right. Gold, we're looking to buy 1237. Did we get there? By 2 points, by 2 ticks. So what do you call that? You call that a stop out. Plain and simple. Nothing else you can say, nothing else you can do. If you took the trade, you got stopped out. That's the truth about trading. If you've never read The Truth About Trading, Google CFRN, The Truth About Trading, and you'll learn, guess what? The truth about trading. Yeah. That no matter who you are, no matter how talented you are, you can own every indicator and oscillator on the face of the earth, you will still get stopped out. It's part of the business. Just like the Subway sandwich shop guy has to buy meats and cheeses and soda pops, you as a trader have a cost of doing business. It's called the trades that get stopped out. Now, where so many vendors get you is they promise you that they have, clever devils that they are, figured out a way that you don't have to get stopped out again. Now, some of them do it by using these incredibly huge stops, which is bad science. In other words, they'll risk 5 points to make 2. That will eat you alive. You might have a couple of good days, but trust me, it's going to eat your lunch at some point. All right? Okay, so 1232, if I can get a straight line here, we can be done sooner. Let's try that. 1232. All right. So the word was, when the email went out, sell 1232. Important prices, important areas. Chart after chart after chart, day after day, we see the same thing. Okay, price comes down, gets to a swing low of 1229.8. So let's just call it 1230. Let's call it 20 ticks. Gold pays $10 per tick. Okay? All right. And then price gets back above the trigger. And down we go again. And boy, this time, this thing means business. If you triggered on this 30-minute candle and trailed your stop, this thing put in a low all the way down at 1218.40. if we calculate 1232 minus, what'd I say? 1218.40. We'll just call it 1219. Round it up. That's 13 points, not ticks. Here, let me spell it in a language everybody speaks. $1,300 per contract available. That's if you simply trailed it down to the low of that candle and then you got stopped out on the little pullback. I guess we could use a dollar sign. The universal sign. That candle, that 30-minute candle, was worth $1,300. If we go all the way to the swing low, if you kept trailing, this thing actually got all the way down to 1210. 1232 to 1210. That would be $2,200 per contract minus 3 ticks. So we'll call it 2,100. How about that? Just to be generous. We'll round it up. We'll be conservative. Because we are pretty conservative. So 2,100 per contract available. All right? So there we go. So that's the story on gold. Got stopped out on the long side. You had an opportunity to get your points for the day and then some on the short side, and then you had a shot at big bucks. $2,100 per contract. And then, of course, you get stopped out on this pullback. Okay. Now, let me show you. Insert indicators. Boom, boom, boom. And they populate. All right. Now, where would you have been told by our indicators to exit this trade? Right there. At 1217.40. Okay. That's your get out spot. 1217.40 by following the indicators. 1217.40. Okay. So let's say you got in at 32 and you got out at 18. We'll even round that up. 32 minus 18 equals, that's 14 points at $100 a point. So using our indicator set to take your exit, $1,400 per contract. Not too shabby. All right, we're almost done because I got appointments and I know you got stuff. And so let's go to the bonds, see if anything of noteworthiness happened there. We'll drop our line at 2000. We'll drop our line at 2000. Okay. That's 2030. Oh, wait, no. 2145. We need to be dropping that thing. 24. We need to drop it at 22. Not that it's made any difference, but there we go. All right. 2145, 20. Yeah, that's right. Okay. So, bonds. Tell me about it. Buy 64.27. Sell 63.30. 64.27 is right here. So that's a doer. Twice. Because important prices and important areas. Yep. Buy. Not but. Buy 164.27. Okay. So you had two opportunities to do that. First time, you put in a swing high at 165.10. Now, there's 32 ticks to a point. So from 7 to 32, that would be 5 plus 10. That's going to give you 15 ticks that were available. Okay, that's how high it ran. You're going to get stopped out on the pullback. The good news is bonds pay $31.25 per tick. So if you only had 4 ticks, that would be $125 per contract. 1 point in bonds. In other words, if we had gone from 164.27 to 165.27, that would be $1,000. But we didn't. We went to a swing high of 165.10. Over here, we went to 165.02. And so that's going to be 7. All right? So with 7, does that still allow you to grab your 4? It should. Sell side on the bonds, 163.30. Okay? Didn't happen. So all we had were 2 long opportunities on the bonds. Last but not least, the unkindest beans of all. I kept bragging about those November beans. Oh, they're the kindest beans of all. And then along came K. Man, and it's been hasn't been as much fun. How about that? We'll leave it at that. We won't call it names. All right. Item beans, we were looking to buy 918, sell 904. Did we have a chance to buy 918? Just barely. See, this is the thing I'm talking about. Buy 918. What's the swing high? 20. Exactly 2 points. Okay. Beans pay $50 a point. So those 2 points represents $100 per contract per day. So once again, maybe we can be friends with the mean. I don't know. It's hurt me so many days. Hurt my feelings. Sell 904. That didn't happen. And so that's where we're going to wrap it for this day and for this week. Buy 918. Okay. Let me take one final glance at the chat box. Let's see. Gary says, I believe some trade well and don't analyze all that well, and some analyze well and don't trade all that well. You can quote me. I think you're right, Gary. It's 2 distinctly different traits or skill sets. Analyzing and then actually putting on the trade. In fact, a lot of firms, in fact, most firms have analysts and traders. The analysts tell the traders where they think the market's going, and then the traders get in and jockey for position. Because I remember when I used to have a flesh and blood stockbroker, and I would go and sit at his desk, and he would tell me about the latest, greatest company that was at 90 cents going to $90. Never happened once, but he's still my friend. And when he would, I'd finally say, okay, well, I'll take X number of shares if you believe that strongly in it. He would pick up his phone and he would call the trade desk and he would tell them, and then he would email me later on in the day where we got filled. Okay? So he was the analyst, and they had somebody else at the firm who was the trader, the guy that actually put on and took off the trade. Now, that was many years ago. See, today you and I have direct access to the market. We can be both the analyst and the trader. Okay, look what happened. We spiked above. Okay, we got up to a high of, so far, 63.50. Question is where will we close? And if we close above it, then I might have to take my shoes off to count how many times it's happened. And if we don't, we don't. So we'll just have to be patient, see what happens. Dwayne, today's show was a real treat with Peter and Garrett. Thanks very much. Eugene, thank you, sir, for your kind words. To all of you who have shared kind words throughout the show, you're appreciative for what we do here. I mean, it takes a lot of work, in case you didn't know. I mean, I wish this all just fell together and just happened, but it really does take a lot of hours, a lot of manpower, a lot of work just to get through a one-day show. Now, Bob Z says he can't hear me, but I'm pretty sure everybody else can. Oh, Bob says, there you are. Bob, you got here just in time to hear me say goodbye. So yeah, guys, it takes a lot of time and a lot of hours just to put together a normal show. When we do something special like what we did today with Peter and Garrett, then, by golly, it takes even more time. But when I get your comments in the chat box that say thank you and we appreciate it, then it makes it all worth it. Makes it worth the effort. And I'm going to ask you a favor. I don't ask much, but if you really enjoy our show and what we bring to you, on our homepage, there's a little link there to our BBB page. And if you want to leave us a review that says, these guys are, pretty swell, that's appreciated. But above and beyond that, a short email that said, hey, Dwayne, thanks for having Peter and Garrett on the show today. I learned a lot. It was very interesting. I will forward those emails on to Garrett and Peter, and that would be encouraging to them, and it just might encourage them to come back on the show a little more often and share a little more of what they do. I know that last part that Peter showed about how he uses that method he has for intraday trading with those 28-minute, I'm sure some of you right now have got your trade station out and you're trying to duplicate that 28-bar, 28-minute chart, whatever it was. I'll have to read my notes. And if any of you get it figured out and you have TradeStation and you want to come on next week and show your charts based upon what you learned from Peter today, I'd love to have you do that. So just send me an email, support@cfrn.net. You can call us anytime at 949-42-EMINI. We do have a 90-day mentoring program. Now, our mentoring program, our mentoring program is 90 days for a reason. Because even though that guy on late night TV says he can teach you how to trade in 5 days for $7,000, I don't believe him. I've yet to meet anyone who learned how to trade in 5 days, no matter how much they paid. So, we give you 90 days of 2 hours a day in the live trading room where you get to ask all the questions you want. We give you our strategy. We give you our tools. We give you our indicators. You own them for life. You get to come to the workshop every Thursday night, ask all the questions you want. There's hundreds and hundreds of hours of training and live trading videos in the members area of the website. Plus, you get unlimited private one-on-one mentoring as often as you need during the course of your 90 days. At the end of the 90 days, if you want to remain an active partner and stay connected at the hip, nothing changes. You still have private mentoring, you still have the live trading room, you still have the workshops, you still have it all. There's a minimum monthly maintenance fee of just $75 a month. So if you've already been through the trial and you want to get busy this weekend as a partner, getting your charts set up and getting ready to go to work Monday morning. Now remember, going to work doesn't mean trading live. No. Before you go live with us, we don't just throw you to the wolves like some folks. We want you to put together 10 consecutive days in a row in Sim where you make $100 a day in 10 trades or less. When you do, because nobody can luck their way into 10 days. If you honestly put together 10 days in a row where you make $100 in 10 trades or less and then put the mouse away, That shows that you have actually learned a skill set, something akin to driving. Once a person taught you to drive, it was difficult. You may have had a few fender benders. You had to go through this mental checklist every time you got in the car. But now, if you want to go to the store, you don't even think twice. You just grab the keys, get in the car, belt up, and go. You obey all the laws. You stop at stop signs and red lights, and you yield the right of way. You use your turn blinker. You don't speed. And you do it without even thinking about it, really. You know, your mind's far away, but yet you're obeying every law and driving defensively. That's how trading is. In the beginning, there's a lot of pressure, and you feel uptight, and you got to go check. And then all of a sudden, one day, you go, hey, look, Ma, no hands, I'm trading. And you smack right into a tree. Remember, on the bicycle? It'll happen. But what do? You get right back up, and you go around the block again. And you go around the block again. And pretty soon, you can go around the block without hitting the tree. Now you're trading. And you build your business one contract at a time. I was in a mentoring session with somebody the other day. He says, you know, I got a pretty good bit of money put away. I understand everything you're saying. How about I go through the 10 days and I learn, you know, how to be consistently profitable, but then I'll just go live with 10 contracts, you know, because I got the money. And if it's the S&P, that's only $5,000. You know, that's no big deal for me. I'm like, well, I can't stop you from doing that, but I can beg you not to. Please just go through the program the way it's lined out. One contract, increase your account balance by $2,000, add a second contract, at the appropriate time as outlined in the blueprint, add another contract. Would you do that for me? And he said, maybe. So we'll see. We'll see how that works out. I gotta go, guys. If you want information on the course, what it costs, it is a fraction of the late night infomercial guy. You'll be blown away at how much you get for the price. Send me an email, support@cfrn.net. We'll send you an email that not only gives you the price, but also it will outline each and everything that you can expect and that you will have and that you'll own when you complete the course. It's all there in black and white so that you can ponder, meditate on it, and decide if it's what's right for you. We would love nothing more than to have you as a part of our community. We really would. But we want you to make a well-informed decision. That's why we give you a 5-day trial. That's why we let you use our indicators. That's why we give you every opportunity to prove to yourself that this is not just another thing, but something you can actually learn how to do. And when you're firmly convinced that it is something that you can learn how to do, we will gladly accept you as a member of our community. We'll always treat you with dignity and respect. We will underpromise and over-deliver till the cows come home. And whenever you need a private mentoring session, just give me 12 hours advance notice on the mentoring page, and I'll be there for you. All right? Now, it is the weekend, so you know the instructions. Please spend some quality time with your family. Of course, I'll see you all in church on Sunday. Thanks so much for tuning in. Whoever you are, wherever you are, may God continue to richly bless you with His mercy and with His grace. And I'll see you at the bell.
Remember this, there is no greater return on investment than to see a human life changed and given hope. As always, pray hard and trade safe. Any financial information discussed on this show is simply the opinion of our host, Dwayne Reeves, his co-hosts, and guests. To learn more about trading Emini Futures or to take a 1-week free trial in our live trading room, Call 1-866-928-3310. 866-928-3310. Information discussed on this radio program should not be construed as a recommendation to buy or sell any security. Always do your own due diligence and consult with a licensed securities broker or financial planner before making any investment decision.
That's awesome. I'll see if I can do anything. I don't think I'm going to be able to, but if I can, I'll call you right back and let you know. But if I can't, could you at least bring me my 5 from yesterday? That's okay. Okay, and I'll check and see. No, I'll check. No, I'll check. No, didn't know there was. I didn't know there was a problem, but I'll check and. He's just. Yeah, he was out there. I don't think he paid you a second look, so don't worry about that. Yeah. Well, maybe if we do it later today, then maybe I can meet you or something. And if there's any way I can get some of those other ones, I will. But I don't think. But if I can at least. Okay. Well, let me check my finances and I'll call you back in a little bit, okay?